Morning, everyone. Hope you're all doing great. Welcome to the next session of your financial management chapter. Chapter number 1 is where we are. And very quickly, before I start with today's session, any doubts you have regarding yesterday's session? Any doubts? Anything you want me to repeat for the topics that we had covered yesterday? Although we had just very briefly started off only with the chapter. But still, if you have any doubts, any generic doubts, any chapter-specific doubts per se. Primary objective of financial management. Okay, so then who in the class is going to tell me? What is the primary objective of financial management? Tell me. We had covered it yesterday. So tell me, we are all looking at what? The whole purpose of financial management is to look at. Anybody in the class? Yeah, Aditya, please send in your doubt here in the chat box so I can then complete it and then finish it off. Logic behind the formula for dividend yield. So basically, we are looking at that what is the level of dividend that we are getting, what is the level of returns on our capital that we are getting from our, from our shareholders' perspective. This example. Total shareholder return. Okay, don't worry, I'll look into it. Somebody from the class is calling me for some reason. Just bear with me for a moment, guys. I have an official call to attend. Okay, apologies, guys. It's just a request for everyone. If you have any issues related to not being able to, enter into the class or any class-related issue per se, please reach out to the IT team and don't call me directly while I'm taking the session, because then I have to put on hold the entire class to answer one of your requests, right? So please stick to WhatsApp, and if it's something which is happening during the class hours, please reach out to the IT team instead. Okay, let's go back. Primary objective of financial management is to be able to arrange for funds, where to, arrange for funds, where to allocate these funds, that is investment decisions, and then talk about what to do with the profits that you have earned, how much to distribute as dividends, how much to hold your retained earnings. I hope that is clear. Logic behind the formula of dividend yield, that is your total shareholders return. So basically, you're trying to find out how much gain has the investor really made during 1 year, right? So what do you start from? There are going to be two elements in it, right? One is going to be your capital appreciation. Capital appreciation is going to be represented by what? The change share price, right? So how much is the share price now versus how much was the share price at the beginning of the year? So how much capital plus the amount of dividend that you have earned during the year. So that is your numerator divided by your share price at the beginning of the year. Do a percentage of it, and that is what is your total shareholder return, right? Do you understand this now? Dysfunctional goals, objectives which do not provide a benefit even in the long run, which means that it is something which is like disproportionate or dysfunctional to where and what we want to do in the long run. However, this is something that we are doing because of maybe that the other competitors are offering it, maybe because there is a demand for it, so you still have to suffice to it. But yes, this is something which is probably not in sync with your long run objectives, right? What type of finances we need and where we need to invest those finances and what we should give to the shareholders. Okay, that was an answer, Nikhar. Thank you. Pursuit of market leadership at all costs, which simply means I want to, as an organization, I want to be a market leader, no matter what it takes. So market leader means I have to be the best amongst the competitors, be it in terms of cost leadership, be in terms of the deliverables that I'm getting. But yes, my organization, my company, my product has to be the number one. Now, even if that has a very strong or a very big cost attached to it, I still want to pursue that example, that objective that I have in mind, even if that means running down my bottom line, even if that means reducing the quality, even if that means rubbing off in terms of your work-life balance of your employees. These are examples of dysfunctional goals, right, Aditya? Second out EPS, a fraction with numerator one one, profit after tax minus your preference dividend. So yes, that tells you that how much is profit attributable to equity shareholders. Divide by the number of your ordinary shares, weighted average number of your ordinary shares. So yes, that is what you need to take. Purpose and how to calculate. Aditya, are you coming via the exemptions route? Have you done your MA paper? Have you done your other skills level paper? Do you know your basic ratios? Because I had made it very clear in the class yesterday itself that I will not be explaining ratios. This is supposed to be brought forward knowledge, guys. There's a reason why it should not be taken up as your first paper of your skills level. And this is exactly what I was blabbering about yesterday. What about wealth maximization? Rishita, I didn't get your question. What about wealth maximization means what? In case of government companies, profit maximization cannot be the main objective. No, Tejas. And that is what we're going to do today. We're going to begin with our not-for-profit organizations, which are obviously your public organizations, which are run by the government. They are operating there for a cause. That cause need not be profit maximization. That cause will need not be looking at just what you want to gain as an organization. But objectives would be to serve a social purpose. So you'd have to calculate the percentage increase. That's why you need to deduct -1 in the EPS growth formulas, right? So that's exactly what I'm saying, Aditya. Please do not choose for FM as your first ACCA exam just after availing your BCom exemptions. You need to be clear with your basics of your MA paper, your ratios. So, explanation of these formulas will not be provided at your financial management level. This is something which is considered brought forward knowledge. And this is just the first set of formula which has been introduced, guys. There are going to be many more coming across, right? So please do not choose FM as your subject. I would very highly recommend you to please follow the order of ACCA, go in for AA paper or PM paper, or if you want to do FM, please brush up on your brought forward knowledge. Right, Aditya? Formulas that you should be aware of. Wealth maximization is an objective. Yes, it's a financial objective that organizations will have. Shareholders wealth maximization. Yes, that's right, Ishita. Anything else, guys? You have done MA and I'm good with most of the basics. So can I take this exam? Yes, if you've done your MA, you're good with your basics, you can absolutely do FM. I'm there to help you, assist you with all your queries, but your queries have to be related to the financial management paper, guys. It cannot be basic, right? Because this is like the beginning of FM really. It's going to just, the level is going to just escalate from here. Right, guys? Anything else you want to ask? For those of you who are still not clear, what I'm going to do is, although I should not be doing this and, spending the class time on explaining the basics, but still, because we're just beginning with, I am going to show you a few concepts that maybe will help you. Concepts again. Not here. It's very, very simple. So you're calculating it in terms of what is basically attributable to your equity shareholders. But still just have a look at a quick video on this as well, just to help you understand the concept once again.
When it comes to assessing our performance, we use total shareholder return, or TSR. TSR, put simply, is the total rate of return we earn from investing in the shares of different companies over time. When you've invested in and own a stake in a company, as we typically do, there are two ways you can earn returns. Firstly, the company's share price could rise or fall. This affects the value of your stake. Secondly, the company could take money out of its earnings to pay you a dividend. TSR has two components: share price return, or the change in share price from your investment; dividend yield, or dividends you receive for each dollar you invested. Let's take a simple example with a 1-year TSR. Imagine that at the start of the year you invest in one share of Company A, priced at $100. During the year, Company A pays you a $5 dividend for the one share you own. At the end of the year, Company A's share price increases to $110. The share price return is therefore 10%. The dividend yield, on the other hand, is 5%. Your 1-year TSR is hence 15%. But short-term TSRs don't tell the full story of Temasik's performance. As a generational investor and owner, we focus on delivering sustainable value from our portfolio over the long term. Our focus, hence, is on longer-term returns. This ensures we maintain the discipline to stay on course through the ups and downs for the betterment of generations to come.
Okay, so I hope this is clear now. Okay, now any further doubts you have? What basics you should know? Basic minimum that you should know is just basic ratios that are there, right? That's all that I really, want you to be familiar with, because then you'll be able to at least begin with your basic concepts of financial management, right, Nikhar? Is this okay? It's still clear, says Shahid. What about others, guys? Please ask if you have any more doubt. Okay, so I hope it's a good time to then start with today's session. There were a couple more students. Aditya, is this okay now? Who had asked? Let me just check. Rupesh, is this okay? Aditya, Rupesh. Yeah, I think that's about it. Okay, wonderful. Thank you. Thank you so much, guys, for your confirmation. So let's then begin with where we left from yesterday, beginning with our not-for-profit organization. So we had started off yesterday. We understood that, private organizations, listed organizations, they are there with a very strong financial objective of increasing the total shareholder return, increasing your total profit maximization, shareholders' wealth, Earning per share, these are the few financial objectives which every private listed organization works upon. But like we had, a query in the chat box, is every organization just only going to run after, profits and wealth and, shareholder maximization? What about government organizations? What about public organizations? What about not-for-profit organizations? Obviously, the name itself is not for profit. So the organization's purpose is not to operate for profits. So then what do they basically stand for? What do these public sector organizations stand for? They stand for a purpose, a social cause, as we say it. So their objective is clearly not just to, not to earn profits. However, at the same time, do you think that, yes, they are there for a purpose. The government has opened up so many government hospitals. They are not there to, make profits and all. But do you think that their purpose is to make losses? Obviously, no, right? We don't want to earn profits. However, we don't also want to make losses also. We, at the all times when we are making decisions, we will still be considering our cost versus benefit analysis. So if the benefit that is coming in from this, expenditure of cost is more than the cost being incurred, definitely that is something that this not-for-profit organization may want to go ahead with. Why? Because the purpose itself is to serve a cause, to serve a social purpose. And at same time, we will consider that the benefit is always outweighing the associated cost with it. So not-for-profit organizations include a number of organizations, for example, charities, your public sector organizations. They are not-for-profit. Such organizations are not constrained by cost profit objectives to the same extent as private companies. However, at the same time, they will have, different set of stakeholders expecting different things from them. And when that happens in a publicly listed organization, in a publicly owned not-for-profit organization, you have to really be able to strike a balance. You want to, there will be different stakeholders all pulling apart potentially conflicting objectives. But how do you manage these multiple stakeholders is what your purpose as a finance manager in the not-for-profit organization is going to be. So they have often constraint of having multiple stakeholders with potentially conflicting objectives. Okay, so let's consider this from the perspective of a university, a state-owned university like Delhi University for that matter, right? So now there are many stakeholders which are there in this university. There are obviously going to be students. What do you think that students expect from the university? Tell me, what would be the students' expectations from the university? I'm not able to open this study resource. Bhavesh, from where are you opening? Gone to your My ACCA account and opened up your study hub? Are you not there in the class yesterday? Okay, so quality education, knowledge, reasonable fees, not yet registered. Okay, so Ishita, you have to wait to be registered. Till then, please refer to these notes which I am sharing. And you will be able to, log on to this resource once your ACCA registration ID has been generated. Good quality education. Chahid, I request you to send in your messages to everyone and not a direct message to me only. So that everybody in the class, is able to read your ideas and, resonate with your ideas as well. I want to make it an interactive session and not a one-on-one session. Right, Chahid? So write your messages targeted to everyone and not just a direct message to me. A good quality education, a good networking environment. That's a good point there, Chahid. Nikhar says good faculty, absolutely. Yes, education, cultural programs conducted on regular basis. Yes, absolutely. So all of this is definitely going to involve a certain level of cost from the university's perspective, right? What about the government at the other end? What do you reckon that government would, expect from Delhi University? Government is the one who is funding it, right? So they would at all times be cautious of the associated cost. So they would want to do what? Minimize cost per student. Yes, absolutely. Right? Okay. Education to all, yes, absolutely. That is why they have opened and funded this university in the first place. They will have some environmental concerns as well. Government expects them to create new skills and maximize the output in minimum cost. That's a very good point there, Chahid, because what the government will look from this, public sector organization, which is the university, is maximization of output at the lowest cost possible. Maximum welfare, yes, absolutely. Provide them with valuable human resources. Yes, absolutely. What about employers? So employers like the big fours would be coming down to these state universities, and they would be hiring students as potential employees. So what do you reckon employers would expect from this university? To be able to provide them with valuable human resources? Absolutely, yes. Expectations of these resources should be reasonable salaries. Yes. What else? Hi, guys. Okay, so who else is not able to join in the session? Vishali, you are mentioning that you are not able to join in, but you are there in the class already. I think only one student is getting some problem in not being able to access and, open up the Zoom link. I've shared the number on the WhatsApp groups for the IT people that you need to reach out to if at all you're facing an issue. And if there's an electricity cut, I had mentioned yesterday also that it will take 5 minutes for me to reconnect back to the class because the backup takes 5 minutes to start, right? So I hope these things are clear with everyone. Any issues that you are facing, guys? Okay, so let's continue. So yes, we understood the fact that yes, there are different stakeholders, even if when it's a public sector organization and when it's a public sector organization, there are different stakeholders involved. Each stakeholder has a different, you can say, potential conflicting agenda, conflicting demand from the public organization, basically. So how do you think, how do we manage these conflicting goals? Any idea? What would be the parameter for us to judge whether we as an organization, as a public listed organization, have we been able to fulfill what we stand for? So clearly the parameters are not going to be profit maximization or, wealth maximization or earning per share maximization. That those clearly can't be your objectives, right? So then what would be the criteria for you to evaluate the performance of public sector organization? Any idea? Any guess? Yes, that's a very good criteria. So, that is the base judgment of what we want as a public sector organization. We want to create value for money. Now, what do you understand by value for money? Wow, well done, Yash. We calculate value for money on 3 parameters. The 3 E's parameter. Any idea what these 3 E's are? Since you've mentioned 3 E's, can you elaborate what these 3 E's are? Economy, yes. Efficiency and effectiveness. Wonderful. Absolutely right, class. So yes, these are the 3 E's parameter which categorize as value for money, and that is what we will be evaluating our not-for-profit organizations for. This is the parameter on which we can judge whether our not-for-profit organization has been able to perform effectively, efficiently, as well as with economy or not. So what do we understand by these 3 E's now? What do you mean by the term economy? We want to be as economic as possible means we want to, yes, our cost, keep our inputs, keep our cost per input to as low as possible. The minimum cost, yes, absolutely. What else? What about efficiency? What do you understand by the term efficiency? Here we are trying to maximize the output with minimum cost possible. Yes, absolutely right. Ishita, absolutely right. Shahid, yes, we are trying to look at how to maximize the output at minimum cost. What do you understand by the term efficiently, effectively? Yes, the quality of the results. Have you been able to achieve the ultimate objective for which you were set up in the first place? So that social cause, that objective, are you able to achieve that objective or not? That is called being efficient. Yes, well done, class. I'm so happy that you know these basics. So yes, value for money is the preposition with which we will be reviewing our not-for-profit organizations, right? So the objective of not-for-profit organizations is to maximize the difference between the benefits generated and the cost of their operations. Maximization of this difference is commonly known as value for money and is similar to the profit maximization, apart from the fact that here what your desired output is not profit but your whatever social cause you have started this organization for. So yes, our value for money is achieved by achieving the three E's, of economy, efficiency, and effectiveness. So what do you mean by economy? Economy means securing resources as economically as possible, which means minimizing your total input cost. Efficiency means maximizing output at the minimum input required. And effectiveness means using resources as effectively as possible to meet the organization's objectives itself. So yes, we will review our 3 E's of the university model in this scenario. Quickly read through this. Quickly read through this and understand that whether you understand these 3 terms or not, and please ask if you have any doubts there. Example for efficiency in this chart. Absolutely. Don't worry. We will review all the 3 together. I just wanted you to read through this first. Okay, so when we say economy, we're talking about cost. So what we want to do, we want to minimize our cost per student. So how much is every student, costing the university per se? Costing in terms of the overall cost that the university has to imply for the entire setup, infrastructure, trainers, everything that they have to do, divide by the number of your students, that will give you your cost per student. So our overall objective in terms of economy will be to minimize our overall cost per student. When we talk about efficiency, we're going to talk about let's maximize our output with the minimum cost involved. So efficiency will involve maximizing student, so maximizing the student divided by the staff ratio, which simply means we have got the maximum number of students being operated by one set of our staff, which means that yes, we have, when in schools we say there's a 20:1 student teacher ratio. That is exactly what we are saying here in terms of efficiency. So what is that ratio? So you've got one teacher for every 20 students in the school. That is what we are talking about in terms of the efficiency. So here we want to maximize the number of our output in terms of, pushing that number to the bare minimum cost involved. So that is being more and more efficient. And effective, obviously, is what is the whole purpose of having a university? What is the whole objective of opening up a university? So effectiveness means that we want to make sure that we are pushing our quality of degrees that we are awarding. We are looking at ways in which we are able to push the number of our, we are able to push the number of our quality of the Apologies, guys. This voltage fluctuation is just killing me, but I have got a solution now. The IT team has recommended me to buy a router, which will, help me not get these fluctuations out of my way. So by next week, hopefully, this should be sorted. It's just that, the electricity goes and then the backup takes like 5 minutes to start again, and the entire thing just goes off. Apologies. I hope everybody is back on with me. Light has now like reconnected, so I'm hoping that it will not fluctuate again. Okay, so let's quickly start. Have you all now understood the 3 E's with the model? Do you all understand how do we and what do we consider in terms of economy, in terms of efficiency, in terms of effectiveness? Wonderful. Thank you. Thank you so much, guys, for the confirmation. Right. So now we are going to look at ways in which we are measuring the performance. We clearly all agree to the fact that yes, there are going to be different objectives that every stakeholder is going to have. These objectives are going to be conflicting objectives with each other. One is trying to keep the input down. One is trying to increase the output. One is trying to, work towards the overall objectives, the overall social objectives for which the organization was set up. So how do you then, overcome these issues performance, and how do you basically look at the ways if the organization has really been able to thrive on and, genuinely deliver value for money, as we call it. So to overcome these issues, performance can be measured by either, you use like judgments. Basically, judgments are obviously subjective, and it's a call basically. So you take a call whether the overall university has been able to achieve the objectives or not, instead of, trying to figure out some numbers, because numbers are obviously conflicting with each other. Or you look at yourself and compare performance to other similar organizations or to yourself with your historic results as well. So comparison with similar bodies or against historical results is something that you can look at. Using inputs that high levels of input do not necessarily guarantee an objective is more likely to be achieved. So you have to look at that, you look at just inputs. So how many hours have the teachers really taught? What was the overall cost of an excursion plan that we had, planned for our students? What was the overall cost of the cultural fest that we had held for the students? So you can look at it and consider and evaluate the performance just based on inputs, not the other parameters. So that is also one way in which we can handle these conflicting objectives. So how do you handle these conflicting objectives is what we are looking at here. Okay, so it is not possible to measure the output of NPOs in a meaningful way. However, continuing with the university example, outputs might be a measure in terms of, so what do you look at? You look at whether, they are broader performance measures. Are you looking at in terms of operational performance measures, in terms of the number of courses offered? Are you looking at factor that, this is like the in demand, so let me add on a program on data analytics for my students? Why? Because this is something which is like, a hot topic, and students would really add value to their resume if they, learn this as part of the curriculum itself. So all of that is something that you will be looking at, right? Sure. So we are talking about the fact that how do we basically find out? So, we are looking at ways in which to measure the performance of your not-for-profit organizations. So either one way was to stick to your 3 E's, but we found out that even when we stick to our 3 E's, we see that these measures, these objectives are conflicting. So the other way was to find out some plausible reasons and for plausible ways in which we can actually measure just the inputs, or possibly just measure the outputs only. So just only measure inputs, only measure outputs. So basically we're talking about, or just measure the overall outcomes. So what we are saying here is, when the 3 E's are conflicting with each other, we can stick to one of the E's to measure the performance alone. So that is just, it is just putting the 3 E's in another way as a stand-alone parameter. Right, Jain? So here we are talking about judgments in terms of experts saying that whether, the objectives have been used or, have been achieved or not. Comparison in terms of, comparing your own economy and effectiveness to other organizations or to your own self with your historic performances. Just looking at inputs. Inputs means economically whether you've been able to achieve these, arrive at these inputs or not. Or just considering output. So they basically what we are saying, if the 3 E's put together are conflicting with each other, just measure on the basis of one of these 3 E's standalone. Right? Does everybody agree upon this now? So I'm opening up an activity for you. Now, the following activity obviously assumes knowledge of ratios from your MA paper. Again and again, I've been saying this, iterating this, that a lot of assumed knowledge will be required, especially your ratios, minimum ratios you should be able to calculate. So please, I want everybody to quickly brush up on their ratio analysis skills and have a look at this question. So here is the question. Using the information provided above, compare the performance of the LBC to the industry average for private sector companies. In part, we are required to discuss the validity of comparing the performance of LBC with private sector bus companies. So can you really compare LBC to private sector companies' performance? And then you obviously, there's a theory question where you are asked to explain the meaning of the following terms in the context of performance measurement and suggest a measure for each one appropriate to the public sector bus service only. Remember, the question is asking you to categorically tell what would you understand from the term economy for a public sector bus service, effectiveness for a public sector bus service, and efficiency for a public sector bus service. Right? Now, I want everybody to do this. Let's do one at a time. Let's do these requirements one at a time, because I believe few of you don't have access to this as of now. So just do the first part as of now, where you are required to use the information provided above to compare the performance of the LBC to the industry average for private sector companies. So industry average for private sector companies, you've been given these ratios. Can you calculate the same set of 4 ratios for this particular company, LBC, as well? So very quickly do this, please. For those of you who don't have access to this, please can you note down these 4 ratios, requisite numbers for it, so that I can pull up. I'll pull up and then show you the rest of the question as well, so that you can start performing your calculations. Just note the industry average, guys. Okay, so Bhavesh, you can't download this study material. This is from ACCA. It's available to you for free of cost from your My ACCA account. It is the study hub. So please just open your My ACCA account and open up link to your ACCA Study Hub and select the subject Financial Management. Yes, I will scroll up. Absolutely. Keep calculating. Wonderful, guys. Calculate it for the organization and then compare it to the industry averages. And then obviously when you compare, you have to comment on it as well. And then you have to also comment like, is it, how validated this comparison is really comparing the performance of a public sector organization like LBC to a private sector bus company. Is it something that you should be doing in the first place? Come on, guys, quickly pour in your answer for the second part and also for the third part. Anything, if you are working on this particular platform only, you can also make use of this notes tab to prepare any notes if you want to prepare for yourself. So that is something that you can do, but I would most importantly encourage you to use your spreadsheet options. Quickly pour in the answers, everyone. I want everybody to answer, please. Are we good to go? Have you all done it? Do you need more time? Okay, so then let's quickly review our answers as well. Okay. So clearly, we're going to compare the four factors, the four ratios which have been given to us for the industry. You absolutely need to calculate that as part of your workings. And then when we are looking at comparing, you have to tell me the parameter on which you are comparing. So return on capital employed and profit margins are obviously performance comparisons. You're looking at profitability as your driving factor here. Then look at your asset turnover. Talk about it in terms of, what is the asset turnover for LBC versus the private sector that we're talking about, and how have you, performed in comparison. Talk about the cost per passenger mile. Talk about the fares per passenger mile. These ratios that you have calculated here is going to be part of your workings only. So you do your workings separately, and then you use these workings to to form your answer in a narrative form, but obviously supported by these workings. So whenever you're comparing, you're commenting, you have to incorporate these numbers and then talk about the narratives. Okay, so first of all, let me know if any one of you were not able to calculate any of these ratios first. Just look at these ratios. 5 ratios that we've calculated here. Already given to us for the private sector, so we had to obviously replicate the same. And then fares charged by the bus service is another ratio that we've calculated here, both for the LBC company as well as the private sector. Any doubt in calculation of these ratios? It's brought forward knowledge, but please let me know if you need any help in this. Quickly, guys, I'm waiting for your answer. Sorry, 1 second. Can I also see the solution like you are showing on screen? Yes, absolutely. So everything on this study hub, I am showing you the same link which you would also have as a student. So you press on show at the side of the activity and it will show you the entire model answer as well. And you need not learn it, please. You do not have to learn anything here. The only thing that you have to do is just understand and, understand how to formulate first. Obviously, you should be able to calculate and then understand how are you going to use it as part of your answers to, form a narrative answer out of it. Right? Yatna, what are you not able to calculate? I got one of my ratios wrong, but now I'm clear. Wonderful, Shahid. Will you teach from ACCA Study Hub for the whole batch? Guys, it's entirely your choice. Yesterday also, I had shown you my own PPTs and I also have the Study Hub. I am absolutely comfortable in, whatever way you want me to teach. So if you want me to go ahead with the Study Hub, I personally feel that it's better to study with the study hub, because this is a newly launched resource directly from ACCA. It's valid for exams from September onwards. So it's very much applicable to your upcoming exam in December. So, it would be a good and a hands-on way to start preparing for the exam that is coming up, because this is the resource which is from ACC, so we definitely cannot ignore it. So the way I propose to do the session is to go through the content of the study hub, and then we will do our question practice from BPP practice and revision kits. You have the chart of all such ratios. Just basically, you can just download it from Google as well, guys. Yes, you need to buy ACCA workbook and practice and revision kit as well. My notes will still be given to you on the LMS. That is additional quick revision practice if you want to do before, your exams, that you can use as your revision slides. So that is exactly how I propose it, Shahid, as well. So there is still a need to buy your BPP practice and revision kits. You would still need it, because I will be taking up question practice from it, because it actually has past exam questions. It has exam standard questions, right? So we'll be taking up the chapters from the study hub. We'll be doing these quizzes after the end of every chapter here in the class itself. I will be giving you these practice questions as part of your homework. And we will be doing our questions from BPP practice and revision kit in the class itself as part of your class practice, along with other questions which will still be remaining from your practice and revision kit as part of your homework. So this is my plan for the session. Right, guys? Study text is already there, and plus you already have my notes as well. So for the study text, you can take a call whether you actually need it or not, right? But I think it's only sold as a combo. So you will have to eventually buy it. And as a combo itself, that discount is applicable on the combo itself. So if you buy it standalone, it will be more expensive than if you buy the combo. So better to buy the combo, I feel. But entirely your choice. I will not be taking it up in the class though. Yeah. Okay, so I feel some of the students are still having some issues with basic ratios. Guys, what I'm going to do is just try to help you as much as possible. Again, I'm reiterating, this is considered broad forward knowledge. You should be aware of all these basic ratios. I can only, help you revise them. But again, this will be something that will take a lot of undue time of the class. I'll see if I can give you like a small video to quickly help you summarize everything. So really, this is like basic class 11th, 12th, and basic stuff really. But okay, let's do this. Okay, I think I will just have to spare some time for you to brush up on your basic skills. So I'll start with the introduction. Again, this is something which is supposed to be brought forward knowledge, but because a few of you are actually facing problems, I am giving you this quick recap for you to quickly revise on these ratios, guys. But please, I just request you to spare out some time and do some practice on these ratios if you're still not confident on them. Okay, apologies. I think I had to share the sound again because, okay, there you are. Now you should be able to hear. There you are.
Hi there. In this short video, we're going to introduce the important concept of ratio analysis. Now, ratio analysis is a common part of your studies of business performance. It involves a comparison of data, typically financial data, and the aim of ratio analysis is to use that comparison and interpretation of financial data to gain insights into how a business is performing. Ratio analysis is very widely used in business because it helps answer some key questions. For example, why is one business more profitable than another? Or why is one business less profitable than another? What kind of returns are being earned by the shareholders from their investment in the business or by a business as it invests in its projects? How solvent is a business? Is it able to pay its debts when they become due? How well does it manage its assets, particularly its working capital, such as inventories, debtors and creditors? Ratio analysis helps answer all of these questions, although it doesn't necessarily lead to the solutions to those questions. Ratio analysis is essentially built around financial information from the financial records of the business, and the two main sources of information that you'll typically use as you calculate ratios are the income statement, which is an historical record of the sales, the income and the costs of a business over time, and also the balance sheet, which you'll remember is a snapshot of the assets and the liabilities of a business at a particular point in time. So from the income statement, we'll draw out data such as revenues or income and sales, the cost of those sales, which enables us to calculate and look at gross profit. We look at the operating profit and the net profit or profit for the year when we're looking at profitability ratios. From the balance sheet, lots of useful information. In particular, we often look at elements within what we know as working capital, so current assets such as inventories, trade debtors, current liabilities, which of course includes amounts owed to suppliers. We look at the level of inventories. We look specifically when we're looking at efficiency of asset management at those trade receivables and payables. But also when we're looking at the financial structure of a business, we look at the bottom part of a balance sheet. We're looking at the capital, the reserves, and the amounts that are owed in the long-term liabilities of a business. What we've done is we've produced separate revision videos that show you how to calculate each of the ratios, each of which draws on information from the income statement and the balance sheet. Now, in terms of ratio analysis, the key process involved in this is firstly to gather the data. Of course, most of that will be from the financial accounts of a business. What you then do is you calculate the ratios. Having calculated the ratios, importantly, what you then need to do is to analyze and interpret the results. What's the ratio saying? And finally, and perhaps most importantly, take some action based on it. No point calculating a ratio unless, in particular, if it gives you an insight into business performance, unless you do something about it. In terms of ratios, there are quite a few of them out there. We've grouped them into three main groups. Profitability ratios. This is looking at the returns or profits earned by the business, both in terms of a proportion or percentage of revenues. So gross profit margin is gross profit divided by revenues, operating profit margin, operating profit divided by revenues. So that's a relative profitability based on revenues, but also in terms of the return that's earned on the capital employed in a business. Perhaps the most commonly used ratio there is return on capital employed. So profitability ratio is all about how a business earns returns. Liquidity ratios are all about whether the business is able to pay its way, can it pay its debts? And the two key ones there are the current ratio and the asset test ratio, which use information from the balance sheet. And thirdly, what are known as financial efficiency ratios. Here we're looking at the effectiveness of the way in which a business manages its finances. So how long does it allow customers to take before they pay their bills, receivables days? How long does it take before it pays suppliers, payables days? How quickly does it turn over the amount of inventory it holds in the business? And also the gearing ratio, which looks at the relative proportion of debt in the business as a proportion of the overall capital in the business. There is one more group of ratios known as shareholder ratios, which are all concerned with the returns earned by shareholders. We're not going to group those into this presentation. Who uses ratios? Well, of course, there are many different users of accounts, and therefore there are going to be many different users of the ratios based on those accounts. Lots of user groups are interested in the profitability of a business. Of course, shareholders in particular want to understand what kind of returns are being earned. But of course, if you're a competitor, you're certainly interested in the profitability ratios of your key competitors. And I guess as an employee, you're interested in what kind of returns and profits are being earned by your business. Governments will be interested in profit, particularly when it comes to understanding how much tax should be paid on those profits by businesses. Liquidity ratios also have lots of users interested in them. In particular, I would say that lenders and suppliers are particularly interested in whether a business is able to pay its debts. And that makes sense, doesn't it? If you're a supplier offering credit to a business, you want to be pretty satisfied that the business will be able to pay your invoices when they become due. Similarly, a lender like a bank would look very closely at the liquidity position of a business to make sure that the business is able to pay the interest and the capital amounts owed on a bank loan, for example. When it comes to financial efficiency, it's very similar actually. Shareholders definitely want to make sure that the business is being run efficiently, that the capital tied up in the business is being minimized. Lenders and creditors very, very interested in how the working capital of a business is managed. And of course, competitors will be interested to see whether a competing business is able to manage its assets more effectively, more efficiently, because that could be a source of competitive advantage. There we go, guys. That's just a brief introduction to ratio analysis, highlighting the key areas of ratios and why they're used. What we'll move on to and have done in other videos is to look in the details of how each ratio is calculated, but also look at the limitations of ratio analysis. Hi everyone. In this
Okay, just a quick revision of your gearing ratios now. Guys, I'm just going to do this once. After this revision session today, I'm not going to, cover the topic of ratios again. I should not have been doing this here in your FM class, but because I see a lot many apprehensions from a few students, so please, just take this time to quickly revise your ratios.
This business topic video, we're going to take a look at a really important part of financial ratio analysis, and it's a concept that's called gearing. Now, gearing is a funny sounding word, so it's important to try to remember what it's trying to achieve, what it's trying to represent. Gearing is all about how a business is financed, and in particular it considers the relationship between the amount of finance in the business that is provided by what's known as equity, otherwise known as share capital or shareholders funds, compared with the amount of finance that is in the form of debt, for example bank loans. And the idea of gearing is to try to measure the proportion of a business's capital that's provided by those two things, by equity or share capital and by debt. And there are two main ways of measuring gearing, but actually, to be honest with you, they both really try to achieve the same thing. So depending on which exam course or syllabus you're following, you may be required to know one or both. The right there, the gearing ratio is the more popular, the more common. But in this short video, I'm going to explain and illustrate both of the two main ratios, the debt equity ratio and the gearing ratio. But don't worry, both effectively try to calculate a very similar thing. I've mentioned that gearing is all about how a business is financed. What is the relationship between the different types of finance that help a business run along? The capital structure of a business is just that. It is the structure of the different types of finance that are used to enable the business to progress. And it essentially has two parts. It has equity. This is the finance that is provided by the owners, the shareholders of the business. And that is not just, of course, the share capital that they put into the business, the issue of shares, but also the profits that they retain within the business as part of shareholders' funds. That's the amount of funding that's put into the business by the shareholders, as well as the money they leave in there as retained profits, rather than taking it out as dividends. The other side of the capital structure of a business is the stuff that's not equity, it's called debt. And what this is sources of finance that are provided by external parties, such as banks, which are in the form of debt. Bank loans being perhaps one of the most popular and certainly common forms of debt. But there can be other kinds of debt, such as mortgages and debentures and other kinds of long-term liabilities that the business has to pay back at some stage in the future, and on which it normally pays interest. Now, let's just have a look at a brief and simple example of what we mean by a capital structure and how they might differ. So on the screen here we have some summary information extracted from the balance sheet of a couple of businesses. And let's take a look at business A to start with. So let's have a look. It's got a total capital here of £1 million. The columns are in thousands of pounds, so it's a total capital of £1 million, and that comprises some share capital, which I've labelled A, some retained profits, which as we've seen is part of the equity structure, 300,000, and it's also got a bank loan, which I've labelled C, of £200,000. So if we add those together, if we add together the equity elements, which is share capital plus retained profits, that gives me £800,000 worth of equity. And the only debt in business A is the £200,000 bank loan, so total debt is £200,000. Now let's compare that with business B, which also has capital of £1 million, but it's a slightly different structure. The share capital and retained profits together are £400,000, that's 300 plus 100. However, it's got a much larger level of debt as a proportion of its capital. It has a bank loan of £500,000 and also some other loan capital, which I've marked D, of 100. So if you add those two together, the total debt in business B is £600,000. So the key thing from this little example is to show that a business with the same amount of capital can have quite a different relationship between equity and debt. And if we were to use the first of the ratios to calculate effectively a form of gearing here, debt equity ratio, we can see how those numbers translate into different equity ratios. So for business A, the debt of £200,000 is just a quarter of the amount of equity. In other words, a debt equity ratio of 25%. Whereas business B has a much larger proportion of finance provided by its debt, £600,000 compared with £400,000. Do the maths, and that comes out as a debt equity ratio, dividing one by the other, of 150%. What does this mean? Well, before we move on to the gearing ratio, just a few words on that debt equity ratio and that structure. Why would it be that a business would want a higher proportion of equity as part of its capital? Well, normally equity is associated with risk. It's a better source of finance for businesses that involve more risk. And the reason for this is that debt is not normally suitable for high risk businesses because you've got to pay the debt back and you need to pay interest, whereas equity, there's a higher level of flexibility there in case things go wrong with the business. So you normally find higher equity in businesses that have greater risks, in other words, or for example, startup businesses, but also where the business doesn't want to have to be under the thumb of the debt providers, where it needs some flexibility. However, it's also the case that a business may want to have a high level of debt in its capital structure. In other words, have a high debt equity ratio percentage. And this has been increasingly the case in recent years in economies where interest rates have been very low. For example, in the UK for many years now, and I'm speaking in April 2016, for many years our base interest rate has been just 0.5%, which makes it very cheap to raise debt as a source of finance. And of course, debt is a good source of finance if the business is strongly profitable with positive cash flows, which makes it really easy to pay both the interest as well as to pay the bank loan back. So let's continue our journey on gearing by looking at perhaps the most popular, certainly the most common ratio around gearing, called the gearing ratio percentage or the gearing percentage. And it's a simple calculation. Normally you'll be given these numbers rather than having to calculate the numbers from the balance sheet. You take the non-current liabilities, that's the liabilities that the business owes more than 1 year, and typically that would be the bank loan that is owed over the long term. And you divide it by adding together the equity part of the capital structure and those non-current liabilities. In other words, the total capital invested in the business. And what you then do to express that as a percentage is multiply it by 100. So let's have a look at a simple example of the gearing percentage in action here. Again, two different businesses, similar idea, a nice summary of some information from the balance sheet that will enable us to use that calculation formula. Business C has non-current liabilities, which I've marked as A, of £200,000, total equity of £600,000. So if you add the two together, that's a total capital in the business, equity plus non-current liabilities, A plus B, of £800,000. Therefore, the gearing percentage is 200 divided by the total equity plus non-current liabilities of £800,000, a gearing percentage of 25%. Compare that with business D, which also has total capital of £800,000, but you'll see that actually the non-current liabilities, or the debt element of that, is much higher at £500,000. So we divide 500 by £800,000, and you could round that down to 600, but actually it's 62.5% as a calculation. Now, what does this mean? How do we evaluate gearing? Well, beware generalities about gearing. Normally the textbooks would say a gearing ratio of 50% or higher is said to be high, and that's fine, it's a useful benchmark, but of course it depends on what type of business we're looking at. And normally it's said that if you have gearing of less than 20%, 25%, that is low gearing, and of course somewhere in between, I guess, is normal gearing. But of course the most important thing is this depends entirely on what the business is trying to achieve, what the business's performance is, and also typically what industry it operates in. There are some benefits of having a high level of gearing. One being, debt is cheap. It's a very cheap source of finance compared with the kind of returns that shareholders often look for, particularly in a time of low interest rates. And of course, the other benefit of having a high level of gearing is that it means the shareholders have invested less capital or have kept less capital of their own in the business. They've had to invest less. And high gearing is perfectly acceptable. In fact, it's a definite benefit for a business if the business has strong profits and strong cash flows, which make it easy to finance the debt, to pay the interest, and when the time comes, to pay the bank loan back or the debt back. Many businesses with strong cash flows and strong profits have a high gearing percentage, and it's simply not a problem for them. However, there are some business benefits of having low gearing, and I guess the most obvious, which I'm sure you can appreciate, is that if you don't have lots of debts, there's less risk that the business will fail because of those debts. It will fail if it's unable to repay the interest or pay the bank loan back, and of course then in that situation the holders of the debt, the bank or whoever, effectively calls the shots. Well, if you've got low gearing, the debt providers aren't in a very strong position. And of course another benefit of low gearing is that if you do decide that you need some extra debt in your balance sheet, or maybe to finance a project, you've got the capacity to add some without significantly increasing the gearing ratio. There we go, guys. That's just a brief introduction to and an explanation of this important financial ratio called gearing.
Okay, so we've done gearing now. What I'm going to do is open up your next ratio, liquidity ratios now.
Hi everyone. Welcome to this business topic video, which is going to provide an overview, an introduction to the important topic of liquidity ratios. Let's just first of all explain what a liquidity ratio is compared with all the other financial and other ratios that you may have come across, such as profitability or efficiency ratios. Liquidity is really all about the ability of the business to be able to pay amounts that it owes, when they're due. So does it have the cash or other assets that enables it to pay its current liabilities? Liquidity is all about cash flow. As a result, the kind of information you need to calculate liquidity ratios is largely going to be found not from the income statement, which is looking at the income and expenditure of a business over time, or the cash flow statement, which looks at the historical movements in cash. The information you need for liquidity ratios is going to be drawn from what's known as the statement of financial position, or as it's more commonly known, the balance sheet. The balance sheet is this snapshot of what the business owns or is owed, which is the assets, and what it owes to others, which are the liabilities. So the concept of liquidity essentially requires you to consider and compare two different types of information from the balance sheet: the current assets of the business, and compare them with the current liabilities of the business. Let's just quickly look at what we mean by current assets and current liabilities. Perhaps one of the most common current assets of a business is the cash in hand, or the cash at the bank that the business has. Most businesses operate with at least some cash in the bank. But of course, there are two other main types of current asset. There is the stock, or the inventories that are held by the business, perhaps at the warehouse, perhaps as work in progress, or raw materials that are flowing through the production process for a manufacturing business. So a lot of businesses, particularly manufacturing businesses, hold significant stocks, as of course do retailers and wholesalers. And thirdly, and this happens in just about all businesses of any major size, you've got amounts that are owed to the business by customers, known as trade debtors. These are customers who've been allowed to have sales, allowed to have the product in return for agreeing to pay their invoices a little bit later. Trade debtors. So those are the three main categories of current assets, and what we need is those current assets to be enough to be able to pay what the business owes, which are known as current liabilities. Two main ones to look out for. Firstly, of course, and this again is common in most businesses, amounts that are owed to suppliers. So in this case, we typically call these trade creditors, where the supplier has provided us with some goods and services, we owe them the money, and we should be paying that invoice from the supplier at the right time at some stage in the future. The second current liability to look out for, and this can happen at the same time as a business having cash in hand or at the bank, is an overdraft facility, or an overdraft amount owed to the bank, which in theory is repayable on demand and therefore needs to be included in current liabilities. So we can see we compare current assets with current liabilities, and the concept of liquidity is to see what the relationship is between the two of them. Let's look therefore at a really simple example just to show you how the main liquidity ratio, which is known as the current ratio, how that is calculated. So in this case, we've got a very simple business, and this is a snapshot of some of the information from the balance sheet. At the balance sheet date, it had cash in hand of £10,000. It was holding stocks or inventories at a cost of £30,000. That's tied up in stocks. And it was also owed £60,000 by its customers, trade debtors of £60,000. On the other side of the equation, amounts that the business needs to pay out at some stage in the future, it owed its creditors, likely to be suppliers, £45,000, and it also had a £5,000 bank overdraft, money it had effectively loaned from the bank. That's our simple example. Let's now have a look at how we calculate the most popular, the most common liquidity ratio. It's known as the current ratio, and it's really easy. All you do is you divide current assets by current liabilities. So add them all up together to start with. So our cash of 10, our stocks of 30, our trade debtors of 60 gives us total current assets of £100,000. If we add together the current liabilities of the trade creditors of 45 plus the bank overdraft of 5, that gives us total current liabilities of £50,000. And the way you calculate the current ratio is really easy. You divide one by the other. Current assets over current liabilities. 100 divided by 50 should, even with my maths, give you the answer 2. So the current ratio is 2. In other words, current assets are twice the level of current liabilities. Well, that's your ratio calculated, but I guess the most important thing is, what does it mean? Now, the textbooks will all describe this in different ways, but essentially, most businesses would want to have a positive current ratio of more than one. In other words, they've got current assets that are at least enough to be able to pay the amounts that it owes. And typically, a ratio of between 1.5, 2.5, maybe 1.5 to 3 would suggest that actually the business is in decent position in terms of liquidity. It's got enough current assets to pay the bills as they fall due. By contrast, a low current ratio of below 1 might suggest that the business is struggling to pay its current liabilities. Of course, it's possible to have a very high current ratio and that also to be a problem. So a current ratio of say 5, 6, maybe 10 would suggest that there's far too much capital invested in the business, perhaps tied up in excess stocks, or we've allowed our trade debtors, our customers, to take too much credit. The key thing about top grade evaluation of using the current ratio is to just think about what the number means in context. So for example, depending on which business or industry you're looking at, the current ratio will vary. Take a look at major manufacturers or businesses that are involved in long-term contracts. They often have a substantial amount tied up in work in progress and inventories. In some industries, it's very common for customers to be given long periods to pay their debts, and therefore trade debtors tend to be very high. So the key issue is, what type of business are you looking at, and what are the typical levels of the current ratio? And also, how does that ratio compare with competitors? Because that will give you an indication as to whether a business is competitive in terms of its liquidity position. The other key thing to remember is to look out for the trend. So don't just calculate the ratio, the current ratio at one point, calculate it over a series of periods and see whether it's going up or down, because a sudden deterioration in the ratio could be a good indication that the business has got some cash flow problems. That's the current ratio, and I think for most exam boards that is currently the most, certainly the most popular, and in some cases the only liquidity ratio you're required to know. So check your exam board. But you may also come across this one, which I'll just mention briefly for a minute or so, and it's known as the acid test ratio. And don't worry about the name, it's really a very simple ratio. It's the current ratio, but you make one small adjustment. What is different about the acid test ratio compared with the current ratio is that you eliminate the current asset that is typically hardest to turn into cash, and that's inventories. So you imagine cash is easy, that's cash, and trade debtors, you just get them to pay. But with stocks and inventories, you actually have to turn them into a sale and then perhaps wait for that sale to be paid for you. So inventories can be typically quite difficult to turn into cash in the short term. So the acid test is, if you like, a more stringent test of liquidity. But then you compare it with exactly the same current liabilities that you had calculated with the current ratio. So if we did that with our simple example, do you remember we had 100,000 of current assets, but of that £30,000 was tied up in inventories or stocks. If we take those out of current assets and divide by 50,000, we see that the acid test ratio is less than 2, as you would expect. It's 1.4. How do you evaluate this? Well, I guess the same comments as we made a few minutes ago are also true, that you've got to understand what type of business you're looking at. For some, taking inventories out of current assets has a very significant impact on the ratio, on the acid test ratio. But for service businesses, almost no impact, because very few service businesses hold a lot of stock. So you've got to look out for what type of industry it is, but also not be too concerned if it's if the ratio is poor but the business has a high stock turnover. So supermarkets typically operate on quite a low current ratio and acid test ratio, but it's not a problem for them because they're constantly turning that high level of stock over through sales, and in particular turning it into cash. So there we go. That was a brief introduction to liquidity ratios, the most important of which.
Okay, so we've done this as well. We've just left with few profitability ratios now. Let me show you profitability ratios as well.
Hi there. In this topic video, we're going to take a quick look at the key profitability ratios. Now, profitability ratios are just one of a series of ratios that help you assess the performance of a business. These look at the returns earned by a business, both from its trading activities, from the sales revenue it generates, but also from how much is invested in the business in terms of capital employed. And the reason why profitability ratios are so important is that profit, of course, is perhaps the main, certainly the most interesting reward or return for businesses and entrepreneurs taking risks and investing in their business. And profit is really important. Not only is it a return on investment, but it's also a very important source of finance in terms of retained profits in the business. It's a popular, common measure of how successful a business is. And of course, profit is also linked with motivating factors such as bonuses and other incentives, where performance is linked to profit, the profit earned by the business. So let's just quickly remind ourselves how we calculate profit. Well, in terms of the total profit for the business, it's a really simple calculation. It's total sales or sales revenue, take away total costs, fixed costs plus variable costs. Do that calculation, you get the total profit or loss of a business. If costs are greater than sales, we make a loss. But of course, with profit, there are different levels, and we'll have a look at this when we see how we calculate the different profitability ratios. So, why measure profit? Well, of course, it's important to measure it both in absolute terms, the complete or the total value of profits earned, perhaps in pound value or dollar value. So, for example, a business may make £50,000 profit or $50,000 in a year or a period. But I guess more importantly is also being able to measure profit in relative terms. What is the profit as a proportion of the revenues achieved or how much is invested in a business? That's also quite interesting, isn't it? And that's really what financial and profitability ratios are all about. And we normally get the information we need for profitability ratios from two parts of the financial statements. From the income statement, that's where we're going to get our profit figure. And also, if we're looking at return, the profit return on amount invested, we need to pick up some information from the balance sheet. So let's quickly go through the four key profitability ratios. What are they? How are they calculated? Gross profit margin is the first one, and it's a simple calculation. It's the gross profit, which is sales less cost of sales, divided by the total sales revenue of the business. Obviously, to get a percentage, we multiply that division by 100. Moving down the income statement, we get to a line called operating profit, which is gross profit taking away the overheads of the business. So the operating profit margin is also a percentage, and it's expressed as a percentage, like gross profit, of sales revenue. So we take the operating profit number from the income statement and divide it by the sales revenue number from the income statement, multiply it by 100 to give us the operating profit margin. Moving a little bit further down the income statement towards the bottom, we come to what's known as the net profit, or sometimes otherwise known as the profit for the year. So it's a similar calculation to the previous two. We take the net profit for the year, divide it by the sales revenue for the same period, and multiply by 100 to get our net profit margin. And the fourth profitability ratio is slightly different. Here we're not looking at sales revenue, we're trying to compare the profit earned compared with the amount that's invested in a business. So this is where we need to draw some information from the balance sheet or the statement of financial position. So we take the operating profit number and we divide it by what's known as capital employed, multiply it by 100, and that will give us our return on capital employed, or sometimes otherwise known as ROCE. Let's have a quick look at an example of how these calculations are shown, just so you can see how the numbers are put together. So here on the left is a simple summary of some information from the income statement and the balance sheet. We've got some sales revenue. If we take away cost of sales, that gets us to the gross profit, £300,000 or 300,000. Take away the overheads gets us to the operating profit of 125,000. And then it looks like there's another 25,000 of costs, possibly finance or interest costs, gives us a net profit of 100,000. And from the statement of financial position or balance sheet, we've identified that the business has 1 million invested in it, capital employed of 1 million. So remembering our ratio calculations and our formula, we always show our workings. Gross profit is therefore 300 divided by 500. We multiply that by 100 to get a percentage, which gives us 60%. The gross profit margin is 60%. Working down the income statement, we get to the operating profit, so we can use that to calculate operating profit margin. In this case, it's 125,000 divided by the sales revenue, 500,000. Again, multiply by 100 to give us our percentage, 25%. And you can see a similar calculation for net profit margin. Our net profit was 100,000, our sales revenue 500,000, so we divide one by the other and multiply by 100 to get to a percentage of 20%. 20%. Finally, return on capital employed needs to use that capital employed number from the balance sheet, and we're going to pick out the operating profit number, 125,000 divided by a million, multiplied by 100. Hopefully your numbers agree with mine, 12.5%. So that's been a brief introduction to the ways in which you Hi there. In this business topic video, we're going to
Last one, guys. The remaining ones, if you're still not sure, please refer to YouTube videos like this. But this is the last one I'm going to show in the class today.
going to take a look at two key ratios that are associated with the returns that shareholders earn from their shareholdings in business. We're going to take a look at shareholder ratios. Now, you may have come across a whole series of different ratios in relation to business performance and financial information, perhaps come across liquidity, which are to do with the cash position of a business, profitability ratios concerned with the profitability or the return of the business as a whole. Shareholder ratios are quite specific in the sense that they look at life from the perspective of the shareholder or the owner of a business, and they concern and try to assess the return that the shareholders get from their investment. So let's take a look at the two key ratios, but also think about how shareholders get their returns. When you are a shareholder, you're aiming to try to get at least one, but ideally both, returns from your shareholding. Firstly, the business may decide to issue a dividend, which is a payment to shareholders out of profits. And also, you're trying to hold on to the shares until their value increases compared with the price that you first paid for the shares. So the increase in the value of your shareholding, this is known as capital growth, or very commonly known as a capital gain. And ideally, as a shareholder, you get both of those returns during the course of your shareholding. Dividends are worth noting down. If you've not come across this term before, you don't need to know a lot of detail except to understand that this is a payment out of the reserves or profits of the business that is made to the shareholders, and the dividend is usually declared per share, an amount per share, for example 10p per share held, and therefore obviously shareholders with more shares get a slightly higher dividend because it's more shares times the dividend per share. Now, most companies don't have to pay a dividend out. It's usually a voluntary thing that the board of directors will determine. But in reality, most companies whose shares are listed on stock exchanges do pay a dividend. Capital growth is a slightly different concept. The idea here is that you buy your shares for one price and hope that that share price will increase over time, giving you the opportunity to sell for more than you bought the shares for. So a capital gain or capital growth arises when the value of the business increases, and a good proxy for the value of a business increasing is an increase in the share price. But of course that capital gain only really arises when you sell the shares. So whilst it might be there on paper, it only becomes a real gain that you can go away and spend once you've sold your shares. And of course the other point to remember is that the share price or value of a business can go down as well as up. So it's entirely possible, indeed often likely, that you're left with a loss on the value of your shares if you buy at a price that's too high and the share price subsequently falls. Now, when we're looking at shareholder ratios, there are two ratios to consider, and we're going to go through these just briefly, give you an example to show you how they're calculated, but also point you in the direction of one or two key evaluation points that you can use if you're required to write an answer that uses shareholder ratios. On the screen there, the two shareholder ratios we're going to look at: dividend per share and dividend yield. Dividend per share does exactly what it says on the tin. It measures the amount of dividend paid to each share, and the dividend is usually declared either once a year or twice a year, and it's therefore an absolute measure of return. So if the dividend price was 5p per share, that is what the shareholders get for each share they hold, an absolute return of 5p per share. Dividend yield is slightly different in the sense that it is expressed as a relative measure. It's expressed as a percentage, and the calculation, as we'll see in a second, is the dividend paid out expressed as a percentage of the share price to give a feel for the relative return on investment. So let's have a look. Firstly, how do you calculate dividend per share? Well, the calculation is shown there on the screen. Dividend per share is expressed in terms of a monetary amount. So for example, it could be pounds, and what you do is you take the total dividend paid out and divide by the number of shares in issue that qualify for the dividend to get your dividend per share. So it's a simple division calculation. Here's an example. Let's say that the total dividend paid by the company was £500,000 or £500,000. There were 10 million shares in issue that each qualified for a share of the dividend. That means that the dividend per share can be calculated by dividing £500,000 by the 10 million shares, and that should give you 5p per share. So if every share you hold of the 10 million, you'll get 5p dividend. And to work out your total dividend, simply multiply 5p per share by your shareholding. Now, how useful is dividend per share as a shareholder ratio? Well, of course, it is just a very basic measure of the absolute return that a share returns, that the shareholder receives. But you can probably already see from this ratio that there are one or two problems with it. Firstly, we don't know how much the shareholder paid for the shares. And indeed, many shareholders would have paid different prices for their shares if the business is listed on a stock exchange. So we don't know what that dividend per share means in terms of a return on what they invested in the share in the first place. And also, it doesn't tell us how much of the profit that was earned by the company was distributed as a dividend. So for example, in our case, we distributed £500,000 as a dividend. Well, was that all the profit that we earned, or all the reserves we could have distributed, or was it just a small proportion? How generous is the company being in sending out its dividends to shareholders? So dividend per share is a pretty limited measure of shareholder return. Dividend yield perhaps is a slightly better measure. Let's just have a look to see how it's calculated. Dividend yield is a calculation and it's expressed as a percentage. So you take the dividend per share, which of course we calculated earlier, and divide it by the price of the share price, and typically that is the latest share price. Now, of course, not everybody would have paid that share price, but it's the best measure we have. Let's have a look at an example. Let's say that the dividend paid per share was 10p per share, and the latest share price, according to the FT or the stock exchange, £1.75. So as it stands, what is the dividend yield? What could shareholders expect if they were to be paid a dividend of 10p, and if they were to buy now at a share price of £1.75, we simply divide one by the other and express as a percentage. So 10p, the dividend, divided by the share price of £1.75 times by 100, express a percentage, that's a 5.7% dividend yield. Now, is that a better measure? Well, I guess in certain circumstances it is a better measure than dividend per share. For example, you could compare the dividend yield of your business, your shareholding, with the alternatives, maybe other similar companies on the stock market, to see whether they pay out a higher dividend yield. You could also compare the dividend yield with alternative investments. 5.7% doesn't sound too bad, does it, when interest rates in the UK are 0.5%, and of course savings rates are very low, so that looks like a decent return. So dividend yield can be useful for shareholders as they consider whether to invest in a share in the first place, particularly if they're looking to invest in a business that pays out relatively high dividends. In other words, the shareholder can expect to get a sensible dividend income each year. But of course, you need to be a bit careful with measures like dividend yield, because don't forget the bottom line of the calculation, the denominator, is the share price, and of course the share price moves up and down. So a high yield might suggest that the share price is particularly low, or that the market expects the dividend to be cut at some stage in the future. So dividend yield is useful, but don't forget it's subject to variations in share price changes, and of course it varies therefore day by day. Well, we've had a look there at two of the key shareholder ratios, and I just thought it'd be useful to stick on the screen there just for a minute or so some examples of these two shareholder ratios in action. So I've listed 4 companies there that you may be well known to you, just to show how the calculations work and how the dividend per share and dividend yield vary between companies. Now, of course, this is a good indication of how share prices differ. So, for example, Apple, the world's most profitable company, has a share price of $110 as I speak, and it pays a dividend per share, or the latest dividend was just over $2. That would be an effective dividend yield of around about 2%, 1.9% if you were to invest in Apple shares today and get the same dividend next time. GSK, the big global pharmaceutical business, has a much higher dividend yield. It pays out a much higher dividend relative to the price you have to pay to get one of their shares, which at the moment is £14.87. But look at the bottom, ASOS, the pure play e-commerce retailer, it doesn't pay a dividend. It assumes that investors are simply interested in investing for a high growth share price, a business with lots of exciting potential. It needs to retain dividends in the business, therefore it doesn't pay a dividend, therefore the dividend per share is 0, and so too is the dividend yield. So if you're investing in ASOS, you've got to rely on capital gain or capital growth as your source of shareholder return, rather than, for example, a GSK shareholder who may expect to get around about 5% a year just from their dividends. So that's been an introduction to and an overview of the 2 main shareholder ratios.
Okay, so now I really hope you are much more confident. Or anything else you want me to show, just to very quickly, brush up upon your basic skills. You're going to do return on capital employed, because that is again one of the key ratios that will be question forever. You want to see this? Yes. Okay, so if you want, I can show this to you as well.
Hi there. In this business topic video, we're going to take a quick look at one of the most important financial ratios that are used to assess the financial performance of a business. It's called the return on capital employed. Now, of course, don't forget that in business, the main return from business activities is profit. Profit being the difference between total revenues and total costs. But in order to earn a profit, most businesses have to invest. Invest in the business. Invest, for example, in inventories, stocks, warehouses, and maybe production facilities and capacity if they're involved in manufacturing. Of course, other businesses, maybe not involved in manufacturing, also or still need to invest in distribution capabilities, for example, if they're a retailer. So the key point about return on capital employed is that it's a useful way of measuring the relative return, i.e. profit, on the amount that is invested, i.e. the capital invested in the business. So return on capital employed is sometimes shortened to ROCE. ROCA is a key ratio. Let's have a look at it in more detail and also have a think about why it's so useful. Firstly, of course, it's widely used because it's a measure of relative return for individual projects within a business. So when you come to look at investment appraisal and you see the kind of returns that are being made, the target rate of return may well be a target return on capital employed. And return on capital employed is also very useful as a means of benchmarking the financial performance of a business with close competitors or with the industry as a whole to see whether that business is operating efficiently or has higher or lower profitability compared with the competition. So a really useful ratio. How do you calculate it? Well, it's a return and it's expressed as a percentage. And strictly the calculation, it's calculated in different ways, but strictly the calculation is this. You take the operating profit of the business, more commonly the operating profit, occasionally you may be asked to use net profit, and you divide the operating profit of the business by the capital employed in the business, which is defined as being the total equity in the business, which we'll see in a second, plus the non-current liabilities. And both of those numbers on the bottom half of that calculation are drawn from the balance sheet of the business. And of course, operating profit you'll find in the income statements, or otherwise known as the profit and loss account. Because it's a percentage, of course, once we've done that little division there, we have to times it by 100 to express return on capital employed as a percentage number. Now, let's have a little look at an example. And on the screen, what I've done is I've listed out some of the summary information that you need to calculate return on capital employed. And I've done it for two sample or imaginary businesses, Company X and Company Y. Let's just briefly look at this information. A Company X, just working down the column there, has non-current liabilities of £500,000. And on the equity side, it has share capital of £1 million and reserves, retained profits of £250,000. So that makes total equity. Total equity is share capital plus reserves, total equity of 1.25 million. The operating profit business, which is drawn from the income statement, the operating profit is £400,000 from the latest year. And you can see there's some different information for Company Y. It has a higher total equity as a result of a high level of reserves, 1.5 million, and share capital of £1 million, making total equity of 2.5 million. And it also has higher non-current liabilities. It's usually debt of some sort of £700,000. So some slightly different information. Now, if you want to have a go at calculating return on capital employed before you have a look at the solution here, why not just pause this video, have a go, and then when you're ready, start the video again. So let's have a look at the return on capital employed calculation. We said that it was operating profit divided by the total of total equity plus non-current liabilities. So in the case of Company X, operating profit of £400,000, and we're going to divide that by adding together total equity of 1.25 million and non-current liabilities of £500,000. So 400 divided by 1.75 million. Company Y, a slightly different figure there. They have a higher rate or higher level of operating profit, but they also have higher capital employed, 2.5 million of equity plus 700,000 of non-current liabilities. So you calculate 600 divided by, in that case, 3.2 million. And if you do the numbers and times it by 100, you can see that the return on capital employed of Company X is 22.8%, and that is actually higher than the return on capital employed of Company Y, which comes in at 18.7%. Now, that's interesting because the operating profit of the business of Company Y is much higher than Company X. So how come it has a lower return on capital employed? Well, the answer is because it has a lot more capital employed in the business. So whilst its profit is higher in absolute terms, its absolute rate of return, so relative rate of return, ROCA, is lower because it has so much more on the bottom half of that calculation. It has more capital employed and therefore a lower return on capital employed. So hopefully you can see from that how return on capital employed is calculated. Now, a few words just about how you would evaluate or how you could use this useful financial measure. Firstly, to say it is very widely used, and the beauty of it is because it uses published financial information from the income statement and the balance sheet, it's relatively easy to calculate automatically from that information and to compare that information between competitors and between industries. So hence financial analysts use return on capital employed quite widely. But it's important to remember, of course, that the percentage will definitely vary between industries. Some industries have relatively low levels of profit and high levels of capital invested, which would make the return on capital employed relatively low, whereas others, for example, the service sector, has relatively little capital intensity but can have quite high profits. And therefore, you'll find when you compare service sector businesses with, for example, manufacturing businesses, the service sector usually has a higher level of return on capital employed. And of course, the other thing to remember is it's just based on a snapshot of financial information. So the bottom half of the calculation takes the latest balance sheet data when it works out to equity and non-current liabilities. But of course, that's just a snapshot of the position of a business at a particular time. Where return on capital employed comes in really useful is to see, in the case of an individual business, how it's changing over time. For example, it might be slowly rising, which would be good news, which would suggest a more profitable use of the capital invested in the business. And of course, it's really useful for comparing the relative financial performances of close competitors. There we go, that's a brief introduction to an important financial ratio called return on capital employed.
Okay, so that's about it. Do you want to do your ratios as well in terms of your receivable
Hi
and
there.
payable days?
In this business topic
Let's
video,
have a
we're
look
going to
at
take
this
a
one
look
as well
at
then.
two more financial ratios that are both very closely related. They're called the receivables days and the payables days ratios. What these two ratios are all about is the amount of money that's owed to a business and also the amount of money a business owes to its creditors. And of course, this is a big issue in business. Small firms in particular often have to wait for their larger customers to settle the bills. That can be a drain on cash flow. And of course, a lot of businesses try as often as they can to delay paying the people who've supplied them with goods and services. So these ratios we're going to look at here are all about the amounts owed to a business and also how much a business owes its suppliers and how long it takes to pay them. Two key terms to quickly cover before we look at how the calculation is done. Firstly, on the left hand side there, trade receivables, sometimes otherwise known as trade debtors. What these are the amounts that are owed to a business by customers. So a customer buys goods and services, they may be allowed to have a period of credit, say 30, 60 days before they're asked to settle the invoice. So a trade receivable is an amount that's owed to a business by its customers, and that will be shown as a current asset in the balance sheet. On the other side there, trade payables are the amounts that are owed by a business to other businesses and individuals, typically suppliers who've allowed the business to buy goods and services on credit. So trade payables, the amounts owed by a business, and they are typically shown as current liabilities in the balance sheet. What the two ratios show is how long it takes, on the one hand for the receivables days, how long it takes, the average length of time taken by customers to pay the amounts that they owe our business. On the payable side, how long on average do we take to pay the amounts that we owe? For example, how long do we take before we settle with our suppliers? Let's have a quick look at how these things are calculated. It's a relatively simple calculation. The important thing is to remember that the output from this is in days. It's not a percentage, it's a days number. Receivable days, you simply divide the value of trade receivables at a particular point in time, and you get that information from the current assets in the balance sheet, and divide that by the annual sales of the business. And to get a feel for what fraction of a year that is, you multiply by 365, which should give you a proportion of days that it takes to pay. Here's a little example for you. Let's say that trade receivables are £25,000, that's outstanding from our customers, and over the course of the year we sold those customers £150,000 worth of sales. So on average if we divide £25,000 by £150,000 and multiply it by 365, on average it takes our debtors 60.8 days, or just over 2 months on average, to pay their bills. So that, in that situation, trade receivables days or debtor days is 60.8. And of course, the key with receivables days is to try to interpret the number. So we know that this is a days figure. It's showing the amount of time it takes customers to pay on average, and that will vary from market to market, from industry to industry. In some industries it might be, for example, normal to take between 2 to 3 months to pay bills. In others it might be expected that you pay your bills, or your customers pay their bills, within 7 to 14 days. So as you look at the number, you need to think about the industry, but also look out for significant changes. For example, a significant increase in receivables days might suggest that the business has got some issues when it comes to collecting debts from its customers. And of course, also look out for the fact that the information for the trade receivables is drawn from the balance sheet, and therefore it's possible just to manipulate that number slightly at the balance sheet date in order to reduce the amount of receivables that are shown as outstanding. The creditors days or payables days is a very simple and similar calculation, very similar to the receivables days. You simply take the trade payables, that's the amount that's owed to creditors, and you get that from the current liabilities number, and divide it by cost of sales, how much we've spent with those trade customers or suppliers. So here's a little example there on the screen. Let's say that at the balance sheet date we owed our suppliers £75,000. We had spent £500,000 during the year with those suppliers. Therefore, if you divide one by the other and multiply by 365, that tells you that on average it takes us 54.7 days to pay our trade creditors or our payables. Similarly, it's important to be able to interpret the data. So remember, with payables days, we're talking about how long the business takes to pay its suppliers. So until it pays suppliers, it has cash in the bank. So generally, a higher figure for payables days is going to be good news for cash flow, because the suppliers are effectively financing the business. And ideally, your payables days would at least be higher than your receivables days, so that you get the cash in from your customers before you have to pay your suppliers. But of course you need to be careful, because stretching that payables days too far, taking too long to pay your hopefully loyal and reliable suppliers, that may suggest that there are some liquidity or cash flow issues. And of course the longer you take to pay suppliers, the more likely it is that they will become slightly unhappy with you, and therefore you're stretching their goodwill. They may decide not even to supply you because of your failure to pay bills on time. The key thing also to look out for on the payables days is to also compare the information that you can receive by calculating liquidity ratios, in particular the current ratio. If the current ratio is weak and perhaps worsening at the same time as the payables days ratio increasing, that would be a pretty good indicator that the business is suffering from liquidity problems. There we go then, that's just a brief introduction to and an explanation of how to calculate these two useful and very commonly used ratios called receivables days and payables days. Hi there. In this
Okay, guys, ratio sorted now. If still you need any further help, please refer to these freely available YouTube videos, guys. It's very easy for you to revise, right? Now, are you in a better position? Have you all revised your ratios thoroughly? Will you be able to calculate these basic ratios now? Should not be a problem anymore. Others, I think there was someone who needed some help. Just one. Okay, who was it? I think who needed some help in ratios? Yatna and few more students for that. I hope it's sorted with everyone now, right? Do we need to write so much big answers? Well, how much big answers you will need to require to write will be dependent on the number of marks allocated for your particular question. So calculation of ratios is just like one part, which is the working part of it. Interpretation of this ratio is what is going to get you marks, not calculation. How you are able to interpret them, how you are able to understand these ratios and go forward is what is going to fetch you marks in your ACCA papers. So yes, length and breadth of answers will be dependent upon obviously the number of marks allocated. So if it's a 5-marker question, allocate, make 5 valid points to be able to gain 5 marks. If it's a 10-marker question, make valid 10 points to be able to get 10 marks. Simple, you can say, guideline to help you with the length and breadth of answers. Right, guys? Is this okay with everyone now? Can you please show me the page where we can get all the ratios? I think there is no page per se, but you can easily Google search, go on YouTube and, get a list of all these ratios as well. Right? It's basic, I think 11th, 12th standard accounting, which is there. Right, guys? Okay. What about this particular question now? Let's come back to this question. What about these particular question? Are you all able to calculate ratios to begin with? Once we are done with the syllabus, will you check our mock test like section C? Yes, absolutely, yes. So we will be assigning you mock exam section A and we will be auto checked by the system. Section C will come to you and I will check it, mark it and come back to you with constructive feedback, right? Okay, again, quick question. Ratios okay with everyone? This particular part. So how do we then interpret these ratios? How do we then answer these, ratios? So what we have is we're talking about ratios from a profitability point of view. We're comparing this and then we're not just, mentioning the numbers. We are probably, we are digging into it that if this is what the ratio is, then what could be the possible reason behind it? So ROC is 0.9 as compared to 10% for the private sector. Profit margins are low at 1.7% as compared to 30% for private companies. Now, obviously, here you have to, there's a huge gap between 1.7 to 30%. So you have to talk about the fact that why profitability is low as compared to your private sector. So this is probably due to the fact that as a public sector provider, LBC has to provide services on a less profitable routes as well as the cost of each route. So the fares that they are connected, that they are collecting might also be subsidized rates because we really want maximum people to be able to make use of this public transport versus, providing the highest on top of the edge extra technological services, which the private sector probably is, looking at. So here the main objective, the essence behind providing this public bus service is obviously maximum good of greater number of people and not profitability. Okay with everyone? What about asset turnover? Now, asset turnover is higher for LBC than for private sectors. LBC's revenue is 0.54 times capital employed compared to 0.33 for private sector. Now, what do you interpret from this number? Obviously, the fact that, this suggests that LBC buses achieve higher utilization than private sector buses. Now, this obviously could be because of the low fares that they are charging, probably because of more passengers traveling in one particular bus at one point of time. So more journeys, more number of passengers taking these journeys as well. This is obviously a good sign because this shows that, like greater utilization of the services being done than the private sector. So there's a whole lot many people who want to use this public sector buses than the private sector ones. Then you calculate your cost per passenger mile is only cost per passenger mile is only 73% of the industry average. Now, do you think it's a good sign? Obviously, this is positive because it means that the company is managing to provide more journey distance for a comparatively low cost involved, well, which simply means that yes, it is effectively and efficiently using its resources. So that is clear. You know the numbers, you've done the workings, but how are you interpreting these numbers and what do these numbers mean to you is what you need to pen down as well. The fares per passenger mile charged by LBC are only 53% of the fares charged by the private sector bus companies. As already discussed, this reduces the profitability of LBC. So you have to look at the fact that you're providing low fares, more people are using this service. So your overall fares per passenger mile is going to be obviously lower than compared to what is being charged by your private sector. And there's a very valid reason for it as well, right? I have all ratios PDF. Yes, please absolutely share it. Otherwise, it's readily available as well. But share it on the WhatsApp group. Share it in here in the chat box. I mean, up to you really. Thank you so much for that, Tejas. Okay, and okay, so part A of the question. Any doubt? Do you all now know how to calculate ratios and how to interpret these ratios as well? Is everybody okay with part A of the question? I'm not calculating this for now because this is like a base level question. But when we'll open up our practice and revision kits, we'll be doing questions together. Not able to share it on the chat box, share it on the WhatsApp group. Right? Wonderful. Okay. So part A, any doubts, guys? Okay. Now, is this a good comparison in the first place to compare a public sector organization like LBC's performance with a private bus sector, industry basically, right? So we obviously find that this whole exercise doesn't make sense really. Why? Because the objectives for which these two organizations stand are completely different. One is working only for profitability, has financial, objectives in mind. The other has social objectives in mind. The other is working with the objective of providing greater good to the maximum number of people, really. So there is, there's a direct comparison. Obviously becomes less meaningful. Why? Calculation of ROCE and profit margins are not relevant for LBC, as that's just not the whole point of LBC, right? That's not what it stands for. So the objectives of these two different sectors is different itself. Private sector bus companies may cherry pick the most profitable routes and avoid going to services which are less populated, which are less profitable for them. However, the government bus service will probably, try to link up the remotest to the remotest village to the nearest train station maybe, so that everybody has that access. People don't have to bicycle or walk or take their, personal tongas to reach to the nearest railway station. So again, because the cause itself for the two organizations is different, it's easier for a private company to just operate on profitable and fancy routes. However, LBC may provide service to the less populated routes as well, because they would want to serve maximum number of people really. The public sector bus company may aim to charge lower fares, probably because, they want to make it a more affordable service for maybe children, maybe senior citizens, maybe pregnant women. But yes, the overall fare structures would be cheaper as compared to your private sectors any day, because here the purpose of taking that fare is not to make a profit, but to be able to, provide the service to maximum people really, right? Everybody okay with why this doesn't quite seems to be a valid comparison? Just read this section, which I'm highlighting for you here. Okay, then the last part, you have to give me all the 3 E's for the bus service. So economy, Obviously, you can look at what is the minimum cost that you're able to get, get that service, get that journey on board really. So, talk it about from the total expenditure process point of view versus what did you originally thought of, what was the original budget for that estimated route from village A to village A, village B maybe, right? What about effectiveness? Effectiveness in terms of whether they have been able to achieve the objective for which it was set up. So are you able to carry the maximum number of people from the remotest of the villages of India to the nearest, desired locations that they want to go, basically? So check on that as well. And efficiency will obviously mean how to maximize the output with minimum input involved. So that you can consider in terms of the cost per passenger mile travel. So are you able to reduce the cost for the maximum, distance traveled really? Okay with everyone, guys? The 3 E's and how you can, what ratios, what percentages can you actually use to calculate the 3 E's here? Any doubts in this question? Devoted way much time on this. But I hope everybody is like done and dusted with your overall ratios problem now. Okay, so environmental issues. Do you think, growing concerns for green policies and eco-friendly environment, one earth, one planet, wherein every organization, be it not just a public organization, but private organizations also need to understand the fact that they have an accountability towards the planet in which we are living, the planet from which we are taking in resources. These resources are judicious resources. We just can't go, gaga and not leave any resources available for our future generations. The concept of sustainability is much, much more important than it has ever been before. So all of these are the environmental issues that we need to consider, acknowledge, and absolutely, go ahead with. Reducing the carbon footprints. Yes, corporate social responsibility is absolutely one way in which organizations understand their accountability to, they take on board that yes, they have to do something to reduce their carbon and their social footprints. Yes, it's their social responsibility as well. So it's definitely a growing concern for everybody on the planet. We have to talk about environment. We have to think about green issues. We have to make sure that, there has to be some accountability coming in from within. And if that accountability requires you to adopt maybe a carrot and stick approach, yes, that is something that you can think of. So that is why, that increasing regulation is happening. More and more governments are becoming more and more vigilant in awarding organizations which has reduced their carbon footprints, and also penalizing organizations which have, just ignored and gone ahead with probably polluting the environment per se. So yes, that is something which is extremely important. So as an organization, we have to think of concepts like triple bottom line. What is triple bottom line? Anybody's ever heard of? Triple bottom line is a concept of true cost accounting. So the focus here is not just, traditionally we were all just focusing on the bottom line. And this bottom line meant what? This bottom line always meant profits, right? But now with increased concerns, with increased corporate social responsibility, environmental issues being more important, the concept of just the bottom line being considered as profits has now shifted to the triple bottom line concept, which is 2 more P's adding on to 1 P of profit. Any idea which are these 2 more P's? 1 P is profit. The other P is, any idea? We will be studying all of this in the next chapter, but I'm just trying to, take some idea. The planet, yes, absolutely, as well as the people on the planet. So all of this has become more important now, not just profits. You have to consider the planet at large. You have to consider the people. People means your human resources, which are, which you are employing, your employees, your customers. They are also being considered equally important by organizations who were just only traditionally focusing on profits as a bottom line, right? Okay, now we come on to a very, very interesting concept, which is called agency theory. I had very briefly touched upon this yesterday. Okay, what I will do is, okay, I'll just start with this topic and then I will show you a quick video on this as well, just to help you understand the concept a little bit more better. So, very, very simply put, we had done this yesterday, but I'm going to reiterate this. Who are the real owners of the organization? Tell me quickly. The shareholders are the real owners of the organization. Who are the people who are managing the organization on a day-to-day basis? The directors of the people. So directors are obviously not the real owners of the company. They are acting as agents on behalf of the real owners of the company to act and run and manage the company. So clearly we see that there is an agency relationship between people who own the company and people who actually are managing the company. Quick question to you again. What do you think would the directors of the company be moving? They, okay, the shareholders of the company would expect from the organization. What would be the expectation of the shareholders? Wealth maximization, absolutely. So maximum return basically for the shareholders, right? Absolutely, yes. On the other hand, directors are not the owners of the company, right? Why would they be inclined towards pushing the, the bottom line for someone else? What do you think would be the, their own personal agendas that directors might have from the organization? Higher salaries, higher remuneration, big fat bonuses. Maybe, their own personal growth as well. Yes, absolutely. So power, more power to them, more growth to them, more personal bonuses to them. So we clearly see that there seems to be a mismatch between what the directors are probably moving towards the organization versus what the real owners of the company really want. So what do we have? Problem at hand. And that is called the agency problem. So how do you reckon we can actually resolve this agency problem? Any idea? Anything that you can think of? Because we clearly don't want the people whom we have, designated as our agents in the company, directors, to be only moving towards their own personal objectives, really. As shareholders, we need to, decide something. We need to basically come up with ideas to align this agency gap. So, any ideas? Target-based incentives, yes, that is one objective. But however, these targets and these profits can clearly be manipulated as well. Then, right, Bhavesh? Does that serve the purpose? I can easily just, cook up and window dress the accounts just to earn my own fat salary. Bonus, really, right? What else can you think of? Making their objectives the same. So yes, that is what you need to tell me. How do you make their objectives the same? Giving them share bonus in a future date. So what we are trying to suggest here, I think Arthav is trying to suggest here is, why not offer the directors, incentives based on shares? So ESOPs, have you ever heard of ESOPs? Employee Share Option Scheme, wherein your directors are entitled to additional set of shareholding in the organization, which is given to them if they actually, they become entitled to it, right? So that share is also given at a reduced price. So that's like a win-win situation, both for the company as well as the directors of the company. What else? What else can you think of? So clearly we are shown an agency relationship here, wherein there is one principal, but the agent is being appointed by the principal, but their goals are not congruent right now. So this goal congruence can be achieved only when we are able to resolve this agency problem. So yes, they are not, if they don't work towards the same set of objectives, then there will be a agency conflict or agency problem in the organization. So how do I resolve this agency problem? By understanding that yes, each of these different sets of stakeholders in the organization will have a separate expectation from the organization, will have their own personal expectations or objectives from the organization. And clearly we see that not just the shareholders and directors, this goal congruence, this difference in the goals is there for all sets of stakeholders. What do you think the employees would be wanting? So shareholders and directors we've done already. What do you think employees of the organization would be wanting? Would be their objectives? Better salaries, absolutely. Bonuses, better working conditions, respect, promotion, yes, absolutely. These would be few objectives of the employees in the organization. What about creditors? What do you reckon would be the expectation of loan creditors in the organization? So who is like a loan creditor? The bank, right? So it would probably want some sort of a collateral. They would want some sort of, prompt payments being done, quick payments being done, interest payments being done. Absolutely. What about creditors? What do you reckon trade creditors would expect from the company? They would want a good credit period to be given to them, right? They would want some leeway in making the payment to the company. Absolutely. What about community at large? What about the society or the community at large? What do you reckon would be their objective? Or what would, they expect from the organization? Employment, better environment, lesser carbon and social footprints. Clearly, so now all of these, this stakeholder objectives, if you see this table on your screen, we clearly see that every stakeholder seems to be pulling the organization in different directions, right? Do you all agree upon that? So as an organization, as a finance manager, it becomes your duty to be able to manage all of these different set of stakeholders, to keep them happy, to keep them satisfied, to keep them, contented with the organization's performance. So that would be one of your primary objectives. But how do you do that? First thing you need to understand is that, yes, there are many categories of stakeholders which the organization will have. And for every category, they will have a different set of expectation, which you should be able to manage in the organization. So there are some category, you can, put it down as an internal stakeholder, connected set of stakeholders, as well as an external set of stakeholders. So internal are obviously people who are working or very much part of the ecosystem of the organization internally. So your employees, your directors, they are your internal stakeholders. People who are connected with the organization. So some sort of a relationship they have, which will include your customers, your shareholders, your creditors, your suppliers, your competitors also. They are called connected stakeholders to the organization. And then there are external stakeholders who are not impacting or, communicating with you on a daily basis. But that these are pressure groups. These are, the overall the government regulation that you need to comply to be able to exist and, continue with your operations. So yes, you must always, tax authorities, local authorities, yes, absolutely. So you must always acknowledge what these external stakeholder groups also expect from the organization, right? Everybody able to understand these different groups of stakeholders and how they all have like conflicts of interest with each other? So absolutely, as a finance manager, as an organization, the overall objective is to keep all of these different sets of stakeholders satisfied. So satisfying them is the overall purpose, that each of these, be it internal, be it connected, be it external set of stakeholders, is satisfied with the organization's performance. So that is the overall corporate objective, is to produce satisfactory rather than maximizing just only one set of group of stakeholders return, which is the shareholders, because you cannot ignore these very important different other stakeholders who are connected to the organization, because these are extremely important set of people, stakeholders, communities, organizations which are very much connected to the organization as well. Okay. Now what I will do is, before I move forward, I'm just going to give you a quick lunch break for half an hour and then we shall continue. So lunch till 2 p.m. and then we shall continue. Thank you, guys. Okay, so I hope everybody is packed from lunch. Hope you all had a filling lunch. Let's quickly resume with the class then and talk about that shareholders. Yes, we have looked at it, that their objectives are different and we need to look at ways, think of ways to bring in goal congruence between what the directors of the organization may want versus what the shareholders of the organization may want. So let me very quickly just mark what we've already discussed here. So directors' personal objectives will include maximizing their personal remunerations, maximizing bonus payments, empire building for themselves, as well as job security also. They are ultimately employees of the organization and they would want to continue with that power, with that position in the organization, right? So that is obviously the director's own personal agendas. However, when you look at, this power that is given to them, does it just come across without any rights being assigned to them? No, right? But all times we see that they do have a corporate social responsibility. They do have an accountability towards the real owners of the company, who are the shareholders. But yes, they can, at times they can be taking up their own personal aspects than looking at the fiduciary duties by encouraging an organization to do what? Now, they can obviously be encouraging window dressing, which we all know what it is, or off-balance sheet financing. Any idea what is off-balance sheet financing? You must have heard of corporate scandals doing special purpose vehicles, these small, subsidiaries you're buying just to show extra losses, and these companies actually just don't exist in the real world. Then you can actually be looking at rejection of takeover offers just because they want to secure their own position in the present organization. So that is also something which is not ethically the correct way to do your job. And also disregarding environmental issues over their own personal agendas, because if you are spending on your corporate social responsibilities in preparing green policies, then obviously everything comes at a cost to the company, and when it comes at a cost to the company, the bottom line declines. And when their own bonuses are probably linked to the bottom line of the company, they would rather try to cut down on this cost, which is ideally the ethical thing to do. Everybody okay till now? Everybody okay till now, that okay, directors are acting as agents, but they have their own personal objectives and they may use manipulative things like window dressing, special purpose vehicles, rejecting takeover offers, or continuing to disregard environmental concerns just for, fulfillment of their own personal objectives. That is what is, the agency cost as of now. Because now we want to do what? We want to make sure that the directors are not following their own objectives. So we want to put in a watchdog. We want to put in an extra cost to keep an eye on what the directors are doing. That is called agency cost. Now, that is something which is obviously a cost to the company, but we need to, incorporate this agency cost because we don't want to end up in a situation where only directors' own personal agendas are being fulfilled by the organization. How we can, resolve this? So we discussed about making them shareholders by the essence of offering them ESOPs maybe, and we obviously need rules, we need guidelines, we need some sort of a pressure on them, some sort of a watchdog on them to check whether what they are doing is correct or not. And all such compliances, all such you can say good corporate procedures come in the form of corporate governance. Ever heard of the term corporate governance? Okay, so let's have a look at something in the class. Scandal relating to off-balance sheet financing. Satyam is a classic case. Sorry, okay. So everybody understand that, yes, there seems to be an agency problem at hand. So we have governance, compliances, rules, policies, and procedures, principles of corporate governance, which organizations need to follow to ensure that this agency gap gets resolved. So that is what the corporate governance policies and procedures are all about. Now, UK based, we have principles based corporate governance, which basically works on a comply or explain phenomena, which simply ask the director, so either you comply to these principles of corporate governance or you explain why you've not been able to comply. So it's more of a relaxed or a flexible corporate governance regime followed in the UK. However, if you head down to companies based in US, it's a rules-based corporate governance regime that is followed, which is called, it is called in the name of Sarbanes-Oxley. Anybody's ever heard of it? Decision of takeovers is definitely the director, definitely the shareholders. But what if they don't, let the shareholders know that, there is this proposal at hand? That is when they can meddle. So Chahit has done it in the BT paper. Wonderful, Chahit. So any idea what corporate governance is, what SOX regime or the Sarbanes-Oxley regime of corporate governance is? It's a rule-based technique. It's a more stringent technique. It's either you comply or you pay the penalties really of non-compliance. So it's stricter, which has its own pros and cons as well. However, ACCA is a UK-based accounting qualification that we are studying. So the focus from your exams perspective will be on the principles-based corporate governance regime, which is more of comply or explain, a more relaxed, wherein we are encouraging, companies to follow the spirit of the law than just, comply to it in a tick box technique. It's generally the system in which companies are managed and regulated. Yes, absolutely right, Chahit. So what is corporate governance? It's a way of telling organizations how to operate, how to control, how to manage their work. And then these are good ways in which organizations can, follow their practices, do their work. And when they do that, they ultimately help in reducing this overall agency gap which exists. Why? Because now we know that they are following the policies and procedures and good ways of managing the organization. Any idea you have? Anything you can suggest? Any corporate governance principle that you know of? Like an example? So we should have a representation of non-executive directors on the board of directors of the company. Who are non-executive directors? I will explain, don't worry, Rupesh. Who are non-executive directors? They are directors of the company who are independent, who don't have any sort of interest in the organization. No, their salary, their remuneration is not linked to the performance of the organization. So ultimately, they are able to review the decisions made by the executive directors, whether this was in the best interest of the company, of the shareholders, or was it a personal decision that has been taken. Yes, they guide the management over how to operate. They approve the work, the decisions of the executive directors, right? However, when we talk about Sarbanes-Oxley, we are talking about a very strict rules-based tick box technique. Okay, you need to have 1/3 members as non-executive directors. You need to, submit a 28 days notice to the directors before doing anything. You need to have being sent across, the annual reports need to be sent across to all the shareholders by post. These are set rules that they need to comply to. So it's more stricter in that ways, because if you don't comply to these rules set by the Sarbanes-Oxley, you have to pay fines and penalties. So it's more stricter. Thus, it encourages compliance. However, at the same time, it can lead to a lot of manipulation as well. It can lead to a lot of, practices being encouraged, which are just promoting a checkbox type of technique that, okay, let's just get rid of this rule that, we've done it. Even though in the essence of it, you've not actually done it. So sometimes SOX, has obviously its own share of pros and cons. However, we will here in the class be focusing on the principles-based, UK principle-based, corporate governance regime, which is more of an essence, more of a principles-based technique, which focuses upon integrity, honesty, of objectivity of the directors in being able to make their decisions. Now, all of this we will have a look at in a detailed manner, so don't worry about it as of now. So let's just quickly have a look at what do we basically understand. So yes, to be able to resolve our agency problem, good corporate governance procedures is definitely a solution that you can offer to the company. So now, what is this corporate governance? Let's have a look at what corporate governance is. What are the policies, procedures, and what do you basically understand by this? Okay. So the first way you propose that we, can resolve this issue, this agency problem at hand, is to bring in more of managerial reward schemes. Managerial reward schemes like paying the managers based on performance, probably offering them ESOPs, giving them a long-term incentive plan so that they are ultimately aligned to the long-term objectives of the organization and not just looking at short-term profit making for the organization. Yes, you need to bring in a lot of transparency in what is happening, why, what happened. So a lot of transparency in your corporate reporting is required. You need your shareholders to be more actively involved in being able to exercise their rights. What is the shareholders' right? What is the biggest shareholders' right that they have? So they must be encouraged to exercise this right, right? And we absolutely we are big time fan of corporate governance. We are looking at appointment of truly independent NEDs, which are non-executive directors, on the board of directors, so that we get assured that any decision being done by the organization would be in the best interest of the organization and only, and not, we are not encouraging any sort of you can say, personal agendas for the directors of the company, right? Does everybody understand this for now? Just read through this once. I've covered all the points, but I want you to quickly read through this once. These are ways in which we are trying to reduce the agency gap. Then I will explain in detail what corporate governance is all about. But first, just read through this once. Short-termism means that looking towards short-term goals. Yes, absolutely. So you're looking at just your present year's annual profits and trying to manipulate and, increase those profits only, and not looking at the overall long-term picture, long-term objective, long-term horizon of the organization, right? Okay, so now we start with corporate governance. So what is corporate governance? What are we talking about in terms of corporate governance? Yes, it's a way, it's a system by which companies are directed and controlled. The objective is to obviously reduce the agency cost, which is going to bring it down to an acceptable level of shareholders, so that that fear of the shareholders, that are the directors actually going ahead and making decisions which is in the best interest of the organization, that gets reduced to an acceptable level. So we are putting in place good governance principles, good ways, good systems in which organizations are able to manage and control themselves. So bringing on your non-executive directors is certainly one of the most important ways of in which corporate governance, talks about and brings in awareness of this and brings in that, okay, that level of reassurance is there, that there's someone independent at the board level representing the shareholders' interests and not just their own personal interests, right? Also, what it greatly talks about is the fact that the CEO of the company and the chairman of the company cannot be one same person. Why we want an independent non-executive director to be on the chair, to be acting as a chairman of the company, to look at all the decisions being made by the executive director, who is the CEO of the company. So there are like two strong pillars in the organization, one executive, one non-executive, who is reviewing each and every decision being made by the executive director. So there is no unfettered power in the hands of one individual who is acting as CEO. Okay with everyone? So yes, the basic principles include that they obviously need to have a board of, a set of board of directors to head the company, to make decisions, to lead and control the organization. Then there has to be two strong pillars of chairman and CEO who are going to be separate individuals. The board itself is going to be represented by a good mix and a good healthy mix of executive as well as non-executive directors of the organization. The directors themselves are not going to be there forever. They have to constantly elect for re-election in on the board of directors as well. Then the corporate governance is very strong on the committees to be formed by the organization, committee of directors to be formed in the organization. Any idea? Anybody's heard of committees in the organization, the forming of board of directors? Obviously, the compensation, the composition of these committees is going to be different. Any idea? So give me, even if it's like an idea, even if it's wrong, it's absolutely right. Audit committee, yes, well done. Audit committee, risk committee, remuneration committee, yes, absolutely. And nominations committee, have you heard of? So yes, they are very much, the corporate governance regime tells us that you have to have all of these very strong committees within the organization and each of these committees is going to be comprised of a different set of members, is going to have a different set of composition of NEDs and executive directors, and their role, their responsibility within the organization is also going to be very clearly demarcated, right? So this is what I want you to first read through. Just read through this. Quickly read through the principles or the primary guidelines of good corporate governance. Yes, absolutely. There's not just a touch of BT. There's a lot of BT in this chapter. Why? Because like I said, this is all brought forward knowledge. So your skills of your MA, your BT, and even your FA skills is going to go one level up with your financial management paper. And not just these skills, but also some of the skills of your financial reporting, which is basically, again, calculation of ratios and all. Then your skills of your taxation paper are also going to be tested as part of your financial management paper. So yes, absolutely. That is why it is put up as last paper on your skills level. Yes, absolutely. Right? Wonderful. Okay. Everybody done with the principles of good governance for now? So let's have a look at government regulation. I've already told you that the companies, UK-based companies which are listed on the stock exchange, they will comply with the principles-based approach to corporate governance, which simply works on the comply or explain phenomena. So let me just highlight this for you. Whereas the companies which are based in the US have to comply to a more stricter regime, which is the SOX, that is the Sarbanes-Oxley Act of the corporate governance, right? So here there is no option given like the principles-based approach. Rules are meant to be followed. Compliance obviously is mandatory, right? Everybody okay till now? What do you understand by the term listing regulations? So if you're listed on the National Stock Exchange of India, our company is required to follow some guidelines provided by SEBI. Obviously, yes, right? Similarly, there are listing regulations for companies that they need to follow worldwide as well. On whichever stock exchange you are listed, you need to follow the guidelines of the requisite stock exchange compliance organization, right? Okay with everyone? Okay, so that actually brings us to an end of this chapter. I'm going to show you very quickly a quick summary of the entire chapter, and then we will open up the quiz as well. Quickly read through the summary, ask if you have any doubts here. Read through it, guys. Please ask if you have any doubts in the overall chapter summary. So this actually covers a lot of questions that you should be able to answer, right? Okay, I'm just going to quickly give you the summary page here, and then we'll start with chapter 1 quiz. Very quickly read through this. You should all be able to answer the list of questions here. Let me know if anybody is not able to answer any of these questions here. And then go through the summary. Let me know when is a good time to start with the quiz, guys, because we will do this together in the class itself. Good to start? Okay, read through it. Let me know when is a good time to start with the quiz. So the fourth point basically shows that often profit maximization and earning per share growth rate are used as proxies, which means they are used as in place of, showing that total shareholder wealth has actually maximized. So these are ways in which you can show that, okay, the overall picture is a rosy picture, right? Any other doubt? Let's start with the quiz. Then I want everybody in the class to please answer. Okay, I had already taken this in my last class. So I'm just going to reset the test again so that I can take it up in this class as well. Okay, so let's start with the quiz then. Okay, there you are. I want you to give me the answers. I will just pick on and then we will review your answers together. Quickly. Quickly have a look at this. This is something that we've just done. And I want everybody in the class to answer. Which of the following is never consistent with the objective of maximizing shareholder wealth? I'm just going to go with the majority and then we will review it together. Next question on your screens. Which of the following is a sign that a company is failing to maximize shareholder wealth? Which one? Financing of the company is via equity finance only. Okay, I'm just clicking on what you're saying. Question number 3. Which of the following is not usually considered to be agency cost? Not considered agency cost. So that I can then go with the majority of the class. So the majority seems to be going in for C. So let's click on C here and press confirm. Question number 4, everyone, very quickly. Which of the following is least likely to solve the agency problem between the shareholders and managers? Everybody needs to answer. The word covenants basically means terms and conditions, like restricting terms and conditions. Okay, again, I'm going by the majority and pressing on C. Question number 5, guys. Which of the following statements about value for money is correct? Quickly tell me. Following statements about value for money is correct. Okay, again, mixed answers is what I'm getting. So which one do you want me to click for you? Which of the following statements about value for money is correct? It says. So which one should I put in? Okay, I think I see a lot of A's. Okay, so let's now review and look at where you are really. So you've got the first question itself wrong. The others are all right. So it just simply said, the first question itself said, which of the following is never consistent with the objective of maximizing shareholder wealth? Obviously, satisficing is what is never consistent. Remember, we had already done this also. We are not just looking here to doing, company managers doing just enough to keep your shareholders satisfied. Obviously, that is not what you want, right? That is not going to be consistent with the objective of maximizing shareholder wealth. Is this okay with everyone? So that is not the overall objective, and that can never be the approach. Okay, but well done. You just got one wrong, so you all scored like 80%. So not bad, I would say. Wonderful. Okay, so now what I want you to do is go back. Let me just go back to the chapter. So the first chapter we've done, the entire chapter we've done. This here has the relevant technical articles which you need to read as part of your question, as part of your homework. Apart from that, you have to do these practice questions taken related to this topic. So go here and do all the practice questions which are there related to this particular chapter that we've just done, right? Make sure you are doing these homework, guys. Plan your answer here, put down your proposed answer here, and then do the next question as well. It's very important for you to do this homework on your ACCA study hubs itself, because this will give you a good typing practice. This will give you a good practice to structure your answers as well. And this is something that you must do. Is everybody okay with what homework is there? So you obviously have to revise the entire first chapter that we've already done. Go through the related questions on your ACCA study hub for it. And you have to also open up your BPP practice and revision kits and do each and every question on chapter 1 from your practice and revision kits. What I will be doing in the class next is taking up questions from the BPP practice and revision kits. So the ones that you want me to take up in the class is the one that I will be taking up in the class. So you have to tell me which questions, you found problematic, which questions you want me to take up in the class. But if you want to tell me, you obviously have to do the questions as part of your homework first. So please, again, I'm requesting everyone, be very sincere in your action plan, in your homework, which I'm giving to you before you come for the next class, because slowly and gradually, we are going to work our way up towards completion of the syllabus. And if you keep on procrastinating, it will get impossible for you to be able to match up to the required expertise at the end of the exam. Please show BPP books for FM. We can see before buying. Yes, absolutely. I can show it to you. Just give me one moment. Let me quickly grab my book. Just give me a second, guys. Okay, I hope you can see me. And this is the set of books you need to buy. It's a little hazy, I feel. Can you see this, guys? Okay, I'll just click pictures and send on the WhatsApp group. I think that will be a better thing to do because of the screen which is set up. It's a bit hazy, but these are two sets of books, which is the workbook as well as the practice and revision kit. It comes as a combo. Reach out to the team at VG Learning. Let me give you the concerned person's name from which you can buy the books. If the concerned person is Sandeep at VG Learning. 83116 is the number, and you can go. No, there is no variant to it. There is one book only. Yes, you have to do each and every question from the practice and revision kit of BPP, plus the questions practice on the ACCA study hub as well. And obviously revise what we have done. That revision part you can do from the workbook here. So revise from the workbook, do each and every question from the practice and revision kit. I hope you can see, right? And reach out to Sandeep. Law has a variant here, but there's no variant for financial management, right? Online book version. Okay, let me just check if I have that on me. Let me just stop sharing my screen for a moment because I have to put in my password. Okay, let me just open up my book as well, my ebook as well. It's going to be the same book basically, but just in the ebook version of it. I personally like to study, and like tick off my workbook, my stuff from the from the physical books. Okay, let me just see if my access is here. Yeah, I don't have access to these new set of ebooks as of now, guys. But I can share. Sorry, what you can share? Let me see what you're saying. But this is the kind of ebooks that it looks like, right? FM link yesterday. Please, guys, don't follow these old links, please. I personally feel it's a very small investment that you're making towards your studies, towards a very important exam that you are heading out to. But ultimately, it's your choice. If you want to use free downloads, please go ahead. But I would very strongly encourage you to buy strong, new set of physical books for yourself, so that you have that, and it's available at a very good discount also from VGLD. So please reach out. If it doesn't suit you, then you can take a decision. But then yes, first at least explore, right? Okay, then any doubt, guys? Anything you want to ask? Anything you want to say? Any feedback you have? Anything you want me to change in the way I teach? Any feedback, good, bad, ugly? Quickly, but we haven't done any questions per se. The next class is where we'll start with question practice from our BPP kits, and we'll be doing questions together. Can I buy only BPP kit? No, it comes as a combo and it comes at a discounted price. So if you buy the combo, it actually comes out cheaper than the individual book. So please buy the combo, because I would encourage you to read through the chapters from the workbook as well. BPP chapters are not really aligned with the ACCA hub. That's okay. They are different publishers, right? But ACCA is the direct examining body, right? So we obviously cannot be ignoring this content. Having said that, you can obviously refer to these approved content providers like BPP to revise and review your chapters really, right? It's question practice. That's it. Yes, we will be following ACCA hub for lectures only, because this is come directly from ACCA, so we cannot afford to ignore it, basically, right? Okay, so question practice, and what I will be doing, I will be scheduling an extra class this weekday, 2 weekdays, because we've missed out on the first week of Saturday, the first week of September. So I will be scheduling 2 extra classes in the following week. The only thing I really want to know here from the class is what suits you better. Do you want to take a morning time or do you want to take an evening time? Evening, I can do 6 to 9 for you. Morning, I can do whatever time you want me to do, basically. Any time after 9 a.m. is okay with me. Okay, morning, evening, morning. Okay, so evening is better after 6:30. Anytime working, evening. Evening is double A classes, but do you have double A classes in the weekdays as well? So then that should be fine, right? Okay, I think so the students want me to take up the evening time because they are working students. So I definitely appreciate that fact. There will just be a couple of extra sessions that will be held up. Usual classes are going to be weekend classes only. But it's just that, I don't want to compromise on quality and not do enough question practice with you. Just to be able to, finish up the syllabus by the mid of November is what I endeavor to do it. What I will do is I will ask the team at VG Learning to complete your ACCA registration, and books you can definitely buy tomorrow itself, right? So just reach out to Sandeep. 13th and 14th, 6:30 onwards. It's perfectly fine with me. Does 13th and 14th suit everybody else as well? You can definitely get your books until then. Otherwise, I will showing up the question to you. Don't worry. Guys, I really have to go with the majority of the class. So Wednesday and Thursday is what is being proposed. For 6:30 to 9:30 is what we can do. And what also I can do, 1 week I keep in the morning and 1 week I'll keep in the evening so that it kind of compensates everyone. 13th, 14th, so seems to be fine with everyone. For now, we'll start from 6:30 to 9:30. On weekends, I'm already speaking for 5 hours on weekends. I'll die of speaking so much. I'm totally drained out after these sessions on weekends already. Okay, see you on 13th and 14th, 6:30 to 9:30 then. And we'll just be doing question practice on the 13th and begin with a new chapter on the 4th, right? So please make sure you come to the class. Homework question you can access here. So here are your homework questions. Right? So when you do this, you will be able to open up your second question as well. Yeah, I am just putting in something so that I can show you the second question also. Please copy your first question homework. Obviously, it shows with your answer as well then. And then you have your second question here. For those of you who don't have access, please click pictures. Click pictures of homework, guys. And for the BPP kits, if you don't have it, don't worry. We'll be doing questions in the class itself. So don't worry about it. Right? So you need to do this and then check your answer yourself. Don't worry. I will check with the team and just do me a favor for those of you whose ACCA registration is not yet complete, but your documentation with VG Learning is complete. Send me a message in the group, please. Right? Till then, click pictures of the second question, please. I will show you the first question again. I'm just typing in something to be able to reach out. Okay, it's lost now. How do I open up? It's a little tricky, but I'll try to go to it again. There are some questions, these are some additional questions that you have to practice. For the practice questions, please pour in the WhatsApp group for those who have not been able to take screenshots. Yes, please. Thank you. Thank you so much, Ahid. Yes, India time would be 6:30 to 9:30. Right, Rofun? 6:30 to 9:30 p.m. we are talking about. We will be sending across group links and everything, but this was just to, take an understanding of what the majority of the class really wants. Okay, then, wonderful. Thank you so much, guys, and I shall see you guys hopefully on the 13th and 14th next. Thank you. Bye-bye.